Welcome to the European Market Open, everyone. A minute to go until the start of cash equity trading. I'm Francine Lacqua in London with Tom McKenzie.
And here are your top stories. Fed Day 1. Traders gear up for the central bank's biggest hike in 2 decades. That's as the 10-year yield tops 3%. Energy agenda. The EU plans additional guidance on Putin's gas for rubles demand to lay out what companies can and cannot do under sanctions rules. Plus, eyes on earnings. BP boosts its share buyback but takes a $25 billion charge from its Russia exit. And BNP Paribas traders, well, they boost and post a bumper quarter amid all this volatility.
Tom, let's look at the futures. So there are a lot of earnings, and of course that will be taken into account to see what futures are doing well and which aren't. If you look at the DAX futures, a nice little lift, 0.8% higher. The FTSE, a bit of pressure, but it's really all about the Fed and what we heard from the RBA.
Absolutely, not just the decision that we're expecting, of course, on Wednesday, but of course the press conference from Jay Powell as well, and what we get from him, not just on the rate hike cycle, but on that balance sheet runoff as well. Yesterday, as you mentioned, a dour day over in the European markets, turned around stateside. You saw some dip buying. The debates continue between the Mike Wilsons of Morgan Stanley and the Kalanoviches of JP Morgan. Kalanovich saying, look, the pessimism around these markets is overdone now. Mike Wilson saying you could see further downsides between 8 and 16% for the S&P. And of course, the 10-year, as we said, that move up in terms of yields to 3%. Negative in terms of real yields, getting back into positive territory for the first time in quite some time. Let's see how things are playing out for the European market today then as well. We had that flash crash in the middle of the session yesterday, which surprised, of course, many investors, and Citi taking that on the chin. In terms of how things are playing out, the Spanish IBEX is gaining 0.8%. The FTSE 100 lower, though, by 0.6% as things stand. We continue to weigh the earnings picture, of course, and BP and its buybacks. We'll get the details on that shortly. The Italian FTSE gaining 0.7%, and over in France, the CAC 40 up 24 points. Let's switch it on to see how things are playing out as we look across then to some of the other assets in play again as the central banks start to vie with the earnings for central and focus in this week. Of course, you have the BOE on Thursday as well. Future stateside looking flat after some pretty decent gains yesterday. Of course, the context being that April was one of the worst months for US equities in quite some time. The Bloomberg Dollar Index also not a lot of movement here, but of course the run up for the greenback is in focus. The implications, of course, for emerging markets there. And in terms of the yields on the German 2-year, you're looking at read across from what happened with the RBA, that surprise hike, 25 basis points from the Reserve Bank of Australia. The expectations have been that you get 15 basis points. You saw a move lower in Australian stocks on the back of that, and the currency higher and yields as well. So looking for the read across here, and you're seeing a 4-point move in terms of basis point move for the yields on the 107, just down by 0.5%. We know, of course, that officials in Brussels continue to discuss how far and how fast they want to go in terms of cutting off their access, their dependency on Russian oil and gas. We'll get the details on that story as well, Francine.
Yeah, and Tom, we of course also have that news that the EU is trying to get closer to some of the Western African countries because of the LNG export, and this is the picture for a lot of these sectors. So it's really energy on the way up. Energy, the biggest gainer by far in terms of sectors, gaining 1.5%, and then you have banks, technology, financial, and insurance. But you see, it's a bit of a mixed picture. So on the downside, we have about 5 industry groups. I'm especially looking at basic resources down 0.4%. So it does seem that there's more movers on the upside, and overall it's tilted towards that way. But I was quite excited. Look, a 10-year yield at 3%. Tom, I know we haven't, maybe I do need to get out more as well, but we haven't had that for quite some time. And of course, it will reprice everything from stocks to bonds.
We're all excited about the 10-year yield at 3%, Francine. Don't worry, we're all aligned with you on that one. In terms of the earnings front, look, this is what the bulls point to. Yes, okay, there's challenges around the economy. They say the earnings are still coming in through, and they're coming through strong. And in terms of these three corporates, earnings beats across each one of them. BNP Paribas, very strong first quarter for this French lender, particularly around the markets division and fixed income as well. The revenue's up about 50% year on year. Very solid in terms of capitalizing on the volatility in these markets for that French lender. You're seeing gains of 2.4% on that stock. BNP, we touched on this, of course, in the headlines. The buyback there of around 2.5 billion. So pushing out that buyback at a time, of course, when they're having to compensate and take a hit from removing themselves from that Russian market for about 25.5 billion. And nonetheless, the investors being rewarded, gaining more than 2% on the back of that news. The buyback really in focus for investors when it comes to BP. And of course, it was a beat on the top line for the first quarter for that oil producer. Deutsche Post is another one that's gaining more than 2%. Another solid beat here when it comes to the first quarter for this German company. So the earnings picture continues to be supportive in a week, of course, when we continue to focus on the rate hike cycle, particularly the Fed coming up on Wednesday. Francine.
Now, Tom, let's get into more of these key market drivers with our market editor, Christina Kino. Christine, I love the way you put it. It's basically the hawk parade. So what lessons can the Fed glean from RBA's experience in delivering these supersized rate hikes?
Well, Francine, it's very interesting that the RBA decided it was going to go ahead of the Fed, and it was going to be a key meeting for the Fed. So they had to show up, and they showed up the Fed really adequately here. I think the key here really was the surprise that they delivered a bigger than expected rate hike. And it's very, very key for Australia. It's a small open economy. It really needed to show that it was going to go the same way as the Fed, but in a way that would be impactful for its own markets. And that's exactly what we saw. And it's really a great lesson in how central banks can deliver kind of that maximum impact with minimal effort, especially in a situation where everyone else is kind of going the same way. Everyone else is tightening. The Fed, of course, is going to be the biggie. But in its own way, the Reserve Bank of Australia managed to make that impact in its own market as well and really deliver those higher yields and potentially more, because they were flagging that inflation will stay elevated, which would give them more leeway in tightening moving forward. And so very interesting lesson for the Fed, who has largely telegraphed the 50 basis point rate hike that's coming this Wednesday. So it's going to be interesting to see what the market reaction is going to be to that, and whether we see a potential sell the rumor, buy the fact situation.
Yeah, Christine, Valerie just pointing out for us, 3-year yields up almost 20 basis points now in Australia. So you talked about the domestic impact. Of course, we've seen that ripple across with this hawkish hike from the RBA. What about more broadly for other central banks? What is the signal?
Well, Tom, it really does signal that this is where we're all going in terms of monetary policy. You know, gone are the days where it's going to be super easy, a lot of support from policymakers. They really are collectively, or by and large, moving toward that tighter monetary policy, really trying to tackle inflation in a big way. Now, this, of course, creates potential divergences, because in various economies, you know, that growth-inflation interplay is slightly different, right? For the UK, for instance, we have the Bank of England meeting this week as well. But here, the question really is the Bank of England about to hike into a recession for the UK? We're certainly seeing signs of certain UK markets, gilts, the stock market potentially starting to price in that recession worry. And so I think the concern among investors is that if they do deliver outsized rate hikes or kind of stay in that tightening cycle, what that does to the economy.
And Christine, of course, that will mean that there are certain stock bulls that will actually, you know, take ahead and say, right, this is where it's going. And then we, of course, have earnings, and it's all about a divergence play on whether you're invested or not in Russia.
Absolutely, Francine. I think, what we're seeing this morning from BNP and BP, there's a lot of kind of angles to play here, and it really isn't a straightforward negative. BNP, of course, benefiting largely from net trading volatility caused by the turmoil in Russia and Ukraine. But of course, they're also warning that that longer-term hit to growth could be something to watch out for, something to be cautious about moving forward. And of course, you have BP, who did take that, almost 26 billion hit, writing down their Russia investment. But at the same time, they're getting that boon from the oil prices, which is, of course, a factor of what we're seeing in terms of energy supply and security as a result of all of this. So I think, this is going to be a bit of a wild card moving forward for earnings. It's not going to be a straightforward negative, and I think there's a lot of divergence to be had here.
Okay, Bloomberg's Christina Kino on that divergence that we're seeing and the implications across these asset classes, and selling pressure in treasuries intensifying on Monday, as we pointed out, driving the 10-year yield to a more than 3-year high as investors do brace for that Federal Reserve and that biggest interest rate hike potentially since 2000. The rate debate rages on, and our MLive Pulse survey results show that most market participants see the 10-year yield peaking in the third quarter.
We think you're going to see about 3.5% on the 10-year from here.
We're expecting a peak of about 3.1% this year in the fourth quarter.
It'll be interesting to see if, in the current cycle, the 10-year can go above 3.24%.
I think we'll get to 3.25 in this cycle.
3.5% is enough to begin slowing growth and start raising concerns about recession into 2023.
It looks like the 10-year has priced in this expected 9 rate hike, and we're pretty close.
We've got more inflation to fight this time.
At some point, the economy starts to weaken. The Fed will be less hawkish.
This is maybe getting to peak hawkishness.
A year from now, the 10-year yields are most likely going to be lower.
I don't think we're at the peak yet. We haven't backed off in the market and sort of seen any proper capitulation yet.
Okay, with us now is Scott Teal, Chief Fixed Income Strategist, of course, at BlackRock. Scott, always a pleasure to speak to you. Great to have you in the studio, of course, alongside myself and Francine. Let's start with that question then. Yeah. Where do you see the US 10-year in this cycle? Do you align with some of those voices?
Yeah, no, we continue to think that 10-year rates are going to move higher over time. Obviously, it's been a very quick move. We had predicted a 2.5–3% 10-year rate for this year. We've already reached that level. But when we look at what's happening in terms of the U.S. economy, we still see the restart being very powerful. The U.S. economy is still below potential. And so we still think there's room for it to grow and rates to move. We look at the yield curve, right? It's been very flat. Although it's steepened recently, it's still very flat historically. You would expect that into a tightening cycle. But as we go through time, we think term premium will return to the U.S. 10-year, driving rates higher in the long end. While I think U.S. front rates are, very, very, very fully priced at that kind of 0.75% Fed
Scott,
funds rate.
is there a danger that the Fed is trying to normalize too quickly, that they'll actually put, that they're dealing with inflation, and they're so worried about inflation that they'll put a slam on the economy?
Yeah, this is our big concern, right, is that they raise rates too much, right? We think a neutral rate, 2.5% to 2.5% is the right rate, because look at the economy is very strong. Inflation is obviously very high. But anything above that is too much for us. Yeah. But I think that we are on a pathway for rate hikes, right? They're going to raise rates 50 basis points. They're going to talk about the QT program, all of these things. And so in the near term, we're going to get rate hikes to that level. But above neutral, in our mind, is too much.
But Scott, 2.5%, is that enough to deal with inflation running at 6–7% in the US?
Well, yeah, we look at inflation, and we do believe in this quarter it's going to start to turn, right? This is a supply-driven inflation shock, right? So we've had, the QT program announced in the beginning of this year. We have what's happened in the Ukraine, and now what we happened in kind of COVID and supply chain issues in China, et cetera. And so we think that as that supply, driven inflation begins to turn, the Fed will realize that the more neutral rate is appropriate as opposed to something more restrictive.
So at what point do you buy 10-year?
Well, I think you got to get through some of the tightening in policy, right? So we remain underweight treasuries in our tactical asset allocation portfolio.
Until?
Yeah, until I think we get some more sign that the Fed is becoming a little bit more conscious of the fact that 3.25, where we're priced now, is too high.
Do you have clarity? Do you and the team have clarity on the impacts of QT and what it means in terms of the run off the balance sheet, the $9 trillion balance sheet?
Well, I think it's going to be, we're going to get some obviously very important information, right, about the pace of the runoff. And also we will probably get some information about the selling of mortgage-backed securities, which obviously is something that we're waiting for as well. You know, I think it's really important question because that's actually what kicked off the rate move at the end of last year, right? It wasn't the rate hike, it was the fact that the Fed had looked at QT earlier than market participants had expected. And so I do think this is an incredibly important, it's true in the UK, we're going to get more information about it this week, the ECB, I think, where it's paramount. So I do think the QT program is really important, and so the way that that is delivered will be, affect this term premium issue that we're talking about.
So is the only certainty volatility, as there could be huge bids to bonds?
Well, I mean, I think that any sign that the Fed is reflecting on the pace of rate hikes, which is obviously not something in the near term, would be significant. Any shift in the QT program anticipation would be significant. But again, I think the reason we remain short of treasuries, right, very clearly, is that we're getting rate hikes, right? We're going to get QT. All across the board, as you talked about. And remember, deep breath, right? We've only had one rate hike in the U.S., right? Look at where inflation is. I mean, we have some rate hikes to get through.
Deep breath.
Deep breath.
Deep breath, people. Scott Veal, Chief Fixed Income Strategist at BlackRock, stays with us and breathe. I like that. Coming up later in the hour, we also speak to Kamaksha Trivedi. He's co-head of Global FX, Rates, and EM at Goldman Sachs. Don't miss that conversation. That's in about 15 minutes from now. This is Bloomberg.
Wednesday, a Bloomberg exclusive. J.P. Morgan Chase Chairman and CEO Jamie Dimon speaks with Bloomberg's Francine Lacqua, live from the J.P. Morgan CEO Summit in London, only on Bloomberg TV and radio.
About what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
If inflation doesn't break soon here, he's going to have to hit the brakes pretty hard. That will put us into a recession.
I think people who have benefited from this extreme low rate, high liquidity environment where growth, all manner of growth have been rewarded, I think that's where the greatest correction will come.
It is simply unfeasible for economics or economies for human beings and their livelihood and well-being to shut down the fossil fuel industry. And I think we're seeing this live in Europe with the Russian crisis.
If the inflation is transitory, if we are heading towards a 4% rate by the end of the year, he has a lot more room to maneuver rates in 2023.
Ken Griffin, Mark Rowan and Jane Fraser there among the speakers at the Milken Institute Global Conference. This year focuses on the forces that bring us together while confronting the issues that keep us apart. Let's check in on what's happening across these bond markets. Of course, we had the RBA hiking more aggressively than many had expected, 25 basis points versus the expectations of 15 basis points, and pointing to further hikes ahead. And of course, we're looking ahead to what happens with the Fed decision on Wednesday and the press conference from Jay Powell. Currently, the sell-off pretty pronounced across the bond markets here. You're seeing the two-year gilt here in the UK, a jump of around 9 basis points, 10 basis points on the 10-year gilt. The German 10-year currently just a smidge below 1% for the first time since, what, 2015 or so. You're seeing a 2 basis point move up in yields of the German 10-year, a 4 basis point move in terms of the German 2-year. Italian BTPs also selling off a 4 basis point move on the Italian 2-year. Fran.
Now, still with us, Scott Thiel, Chief Fixed Income Strategist at BlackRock, also our yoga guru. Deep breaths, it's okay, the Fed's got this. What do you make of the RBA with this bigger than expected rate hike? And actually, is it very difficult to go against the grain of hawkish, tightening?
No, I mean, I think there is this feeling, because obviously the inflationary environment is global, and so central banks move in the same direction. But I think it's also, you got to be cautious. I don't think one central bank necessarily cares what the other one does in many respects. So
really?
I think it's, yeah, I think so. I think it's obviously, again, if the fundamental drivers are the same. I mean, talking about Europe for just 1 second, coming back to this, right? The inflationary impact in Europe is very different than it is in the U.S., given the supply shock that we're seeing, right? And that's going to filter into kind of ECB policy and ECB rates, right? The ECB, the 2023 ECB rate has moved by 150 basis points this year, right? That's a lot. And where we're a little bit more cautious there is the impact of energy on the European economy will be substantial, right, because of the dependence on Russian gas. And so there's going to be interesting dynamics that develop between the central banks, right? Right now, rates are very low, so central banks are being aggressive, right? We saw that in emerging markets last year. They all became very aggressive at the same time. So now the developed market central banks are doing the same thing. But I think as time goes on, there's going to be some important divergences. The Bank of Japan we were talking about earlier is another example where you see they're still in yield curve control mode, right? And look what's happened to the yen.
With the ECB, I just wondered to what extent officials there also focus and have a memory of the bleed that we saw when it came to BTPs and Greek bonds, of course, and what that meant for the Eurozone crisis. Do they have the tools now to be able to address any pain on the periphery once they start reducing stimulus?
See, this, I think, is a very important question, because the QT program, right, one could argue that financial repression, so interest rate repression, is the strongest of the major central banks in Europe because of the pervasiveness of the purchase program, right? The supply-demand, the ECB's purchase program has been the big dominant price setter for the last, really since the Greek bond crisis in some respects. And so I think actually the QT unwind in Europe is going to be really important to how we see BTP spreads react and how peripheral bond yields react, right? Look, Italian political crisis resolved, right? BTP spreads, well, I mean, to some degree, but didn't move materially, right? Well, why is that? Because actually, I think the QT program is more important and how that's unwound. So that's a very, very important part of the ECB's process.
Scott, is there a new neutral, actually, for both the ECB and the Bank of England? From 2021?
We still have kind of neutral rates in Europe at around, 25 basis points and something around like 1.5% in the UK. So we still have some wood to chop as the Fed to get there. But I still think that anything kind of beyond that, we run into this problem, and particularly in Europe, right, where, again, the economy is going to be dramatically impacted by the higher gas prices.
Scott, just briefly before we let you go, what's looking oversold, if anything, in corporate debt?
Well, investment-grade credit in the U.S. now, the yield on the index with today's move is going to be around 4%, right? And so I think if we look at a history of that index at a yield level, that is you know, decade-wide, that's around the high levels. We saw that level actually in COVID, but it was all the spread widening and none of the rate move. And now it's more balanced, right? You have about 125 basis points spread. You have about 275 basis points in U.S. yields. So that to us is starting to look attractive. The other market which we love is, you know, is emerging market local debt, which we still think high rates, central banks have reacted, cheap currencies, that looks attractive as well.
Okay, look to emerging market local debt, and maybe you get to neutral from the Fed, maybe then take a pause or a deep breath. Scott Teal, thank you very much indeed. Fantastic insights.
Always.
As ever. Chief
Wait,
fixed
are we
income
breathing
strategist at
through
Plain.
this?
Yeah, well, I'm going to take this with Scott and just run with it, because we need this at this time of volatility, don't we? Coming up, BNP Paribas post, talking of volatility, they've done well out of this. BNP Paribas boasting a bumper first quarter earnings, largely on the back of those market moves. We're going to hear from the French bank's CFO, Lars Machinel. That is next. This is Bloomberg.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Welcome back to the Open, everyone. 25 minutes into the European trading day, and you can see we're holding on to some of our gains. The FTSE is actually on the lower side, 0.2% lower. But if you look at the rest, the DAX getting 0.6%, just like the Europe 600. U.S. indices actually fluctuating a little bit. I guess there's a bit of dip buying, and that waned at the margin. And then, of course, there's concern over a global wave of monetary tightening, and that's dominating pretty much everything.
Yeah, banks are the leading sector at this point, helped in no small part by BNP Paribas, which reported first quarter net income that absolutely smashed through the estimates. The French bank's trading activities surged, but despite the solid results, the lender said that the short-term outlook was anything but positive. BNP's CFO, Lars Machinel, spoke with Bloomberg's Caroline Conin in Paris.
What we see is that the situation on the eastern borders of Europe, we believe that it might lead to some slowing down in the economy, which is temporary, so which we should pick up again. Therefore, that should be similar in the markets. The first quarter really has shown that the elements and the platforms of growth are really working. And so that is basically how we will proceed. Yes, it might be a little bit still volatile in the quarters going forward.
Well, that was BNP's CFO, Lars Machenil, speaking to Bloomberg's Caroline Conan. Of course, he joined peers in benefiting from some of this market volatility amid energy price spikes. Rising costs are increasing, but actually that's okay because they're trading well. Coming up, we speak to Kamaksha Trivedi on emerging markets.
The end of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali, sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan, bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu, sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to The Open, everyone. We're 30 minutes into the European trading day, and here are your top stories. Fed, day one, traders gear up for the central bank's biggest hike in 2 decades as the 10-year yield briefly tops 3%. Energy agenda, the EU plans additional guidance on Putin's gas for rubles demand to lay out what companies can and cannot do under sanction rules. Plus, eyes on earnings, BP boosts its share buyback, but it takes a $25 billion charge from its Russia exit. BNP Paribas traders post a bumper quarter amid volatility. Tom, if you look at the markets, it's of course all about positioning ahead of the Fed, and then we have, of course, that Russian gas story.
Yeah, there's a bit of dip buying yesterday on Wall Street. Do you run with the bears? The Mike Wilsons of the world over at Morgan Stanley, who says you could see a further downside of between 8 and 16% for the S&P, or do you go with the bulls? The JP Morgan's Kalanovic, of course, saying, look, the nervousness, the angst within these markets is overblown. You're seeing some modest gains across the European space today after the losses that we posted yesterday. Across the benchmark, you're seeing gains of 0.6%. It is, as Francine was saying, about the earnings and, of course, the central banks. And the RBA setting the agenda, at least this morning, with that rate hike that came in more aggressively than many had expected, 25 basis points versus 15 basis points, and signaling that further rate hikes are needed. And that sets us up, of course, for that decision from the Federal Reserve and the presser from Jay Powell on Wednesday, where investors will be laser focused before we get to the BOE. on Thursday. In terms of the DAX, you're seeing gains of 0.7%. Again, as Francine was saying, the conversations about the oil and energy mix from Russia still part of the conversation for officials and policymakers in Brussels. The FTSE 100 lower by 0.2%. Part of this is what we're seeing in basic resources, which was one of the sectors in the red this morning. Let's switch it on and see how things are breaking down then, sector by sector, as we weigh up all of this, the earnings, the inflation picture, and the prospects of further central bank tightening. At the top of the list, it is banks. BNP Paribas is a component in this, coming out with some very strong results in the first quarter. Banking sector gaining close to 2% currently as things stand. Autos and parts, you have a deal from Stellantis to buy a joint venture from BMW and Mercedes. We'll continue to watch that one at 1.6%. Down at the bottom, three sectors in the red, 30 minutes into your trading session, including, as I said, basic resources down 0.3%. Food and beverage also lower by 0.3. Francine.
So, Tom, in case you missed it, it's Fed Day tomorrow. All eyes are on central bank tightening cycle as the RBA kicked off what could be a week of hikes for the world's most important monetary policymakers. Now, our next guest says emerging markets can deliver positive returns even as inflation accelerates and central banks around the world tighten monetary conditions. Well, joining us now is Kamaksha Trivedi. He's co-head of Global FX, Interest Rates and EM Strategy at Goldman Sachs. Kamaksha, thank you, as always, for making us smarter on EM. What do you buy right now?
Look, I think that, emerging markets right now are a picture of both resilience on the one hand, but also fragility on the other, right? So I think that, it is the places in emerging markets which are also hiking rates more meaningfully, who are ahead of that, central bank hiking cycle, have some degree of commodity exposure and are more defensive. A lot of these markets, are in Latin America. As you mentioned, the Fed, we expect them to hike this week. 50 basis points is what the markets and most forecasters are expecting. But it's also a week where Brazil is going to hike another 100 basis points, we expect. Chile is probably going to hike 100 basis points. Poland is going to hike 100 basis points. So I think you have to sort of focus on that group of countries where you're seeing sort of the significant hike delivery, the carry and yield cushion that is being rebuilt. On the other hand, you have fragility, I would say, in a lot of the frontier market economies, which are really bearing the brunt of this, rate move higher on the one hand and commodity price shock on the other.
Kamaksha, what is the dollar component in this, given the run-up we've seen in the greenback?
Absolutely. I mean, I think if you look at the moves in the last month, they're very different from the first quarter of the year. This last month has been a much bigger dollar move. It's been sort of pretty much across the board, including some of the currencies that I mentioned, places like the real, the Chilean peso, all of these currencies which had been a bit more resilient, in the first quarter, seeing more pressure as you're seeing a broader dollar move rather than specific pockets. CNY, the dollar moving against the CNY as well. The growth worries in China also adding to some of the EM strike. The big difference, of course, is that a lot of these local markets, have a lot of their debt in local currencies, whereas places like the frontier that I mentioned, Sri Lanka, which looks to be in default, Pakistan, Egypt, a lot of these other countries have significant dollar debt, and that's where the dollar component is really hurting.
Kamaksha, I want to go back to China and actually look at this chart, which is the Hang Seng Tech Index, and it's fallen some 18% in the last couple of weeks. Has a market narrative on China been too pessimistic? Is this the bottom for Chinese stocks?
Look, I think China is a pretty idiosyncratic market. That's true in the rates component, where rates have been going down in China, even as they've been going up in the rest of the world, and it's true on the equity side of things. There's no question that Chinese stocks are cheap, right? They've been underperforming for a long time, for much of the past year. But if you look at even at the last set of the PMIs that we've just got, what we are learning is that actually the hit from the war in Europe and elsewhere is a bit less than we expected, whereas the hit from the latest COVID shutdowns in China has actually been quite meaningful. So I think the pessimism there is not unjustified. I think the real question going forward is, given the cheap asset that you have, given the cheap stocks that you have, are you going to see an actual move in policy in China getting this COVID bout or wave under control? If that happens quickly and policy moves to a more supportive direction, these things can rally hard. I mean, as they have done in the past, just because they are extremely, extremely cheap.
Where does that leave your views on the yuan then? I remember speaking to Yi Gang, the PBOC governor, back in 2019, June of 2019, and the level then was around 680, 685, and the question for him was, is 7 the line in the sand? It's not about the level, is it? It's about the pace.
Absolutely. I think the yuan can weaken further. I mean, even at these levels, when you look at it, not just on a dollar basis, but look at it on a basket basis, when you look at it, on the CFETS basket or on a trade-weighted basis, the CNY, the yuan, is actually not that weak. I mean, it's actually, at pretty strong levels. So given what is going on in China, the weaker growth momentum in Q2, given this COVID shock, and lower rates compared to rates going up everywhere else in the world, there's no mystery or there's nothing sinister about the CNY weakening somewhat. It's the pace, as you mentioned. They're never comfortable with a very rapid pace, and I think that pace is likely to slow down relative to what we've seen in the last 2 weeks. But we would expect the CNY to weaken further, both versus the dollar, but also on a broader basket basis, and that would still leave levels looking not so far from fair.
Kamaksha, speaking of broader baskets in terms of currencies, what do you do with Japanese yen right now?
Look, I think the yen is an interesting one. I mean, given, again, what I was saying about the monetary policy differentials in CNY, I mean, even a stronger version of that is true in the case of the yen, right? You have, central bank very committed to yield curve control, which is meant to have its most significant impact exactly when the rest of the world is moving in the opposite direction. That's what we are seeing. This is what yield curve control is meant to generate, and you could see further moves in that direction depending on what we get out of the Fed this week. So certainly there's certain near-term weakness possible. What I would say is that for longer-term investors, in a world where people are increasingly nervous about growth, recession risk, and moves down in equities, the yen is beginning to look like a increasingly cheap hedge. So that's not something near term. I think near term, the momentum is still to the weak side. But if you're a longer term investor looking to hedge a kind of growth down, rates down, equity down type scenario, it's hard to find a better hedge than the yen, and it's especially cheap right now.
Where does the longer term bullish view at Goldman take you at this point?
Look, I think that, it's hard to be sort of very long-term right now, given the uncertainties that we are seeing. You have a war on the borders of Eastern Europe that doesn't look like it's going away or de-escalating anytime soon. You have, significant rate hikes coming through, and you have, markets, coming under pressure. I think the real question you have to ask yourself is that financial conditions globally are going to tighten. But are they going to continue to tighten in the way that we've seen the last month with equities and credit leading things lower? Or are we going to go back a little bit to the world that you had a little bit in March, where it's rates moving higher, but actually equity and actually doing all right in that period? I think going back a little bit to that world is going to be easier for emerging markets, which at the end of the day are a cyclical asset to stomach, rather than a world where you continue to see downside pressure on risk assets.
Okay, Kamaksha Trivedi, just fantastic insights, and what a great day to get you on. Co-head of Global FX Interest Rates and EM Strategy at Goldman Sachs, of course. Thank you. And coming up, after months of resistance, Germany says it is ready to support the EU's plan to ban Russian oil imports. We'll get the details on that story next, live from Brussels. This is Bloomberg.
Exclusive. JP Morgan Chase Chairman and CEO Jamie Dimon speaks with Bloomberg's Francine Lacqua, live from the JP Morgan CEO Summit in London, only on Bloomberg TV and Radio.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Welcome back to the Market Open. We are 43 minutes into your European trading day. You're seeing gains of around 0.6% across the benchmark. Top of the list when it comes to your sectors, banks up more than 2%, followed by autos and energy. The sell-off in the bond markets continues. Gilts here in the UK, 2-year up 8 basis points in terms of the yield. The German 2-year also up 6 basis points. So that sell-off across treasuries continues. The RBA coming in with a more hawkish hike than expected. We're looking ahead, of course, to the Federal Reserve as well on Wednesday in that decision.
Now let's get also the latest on the war in Ukraine. After months of resistance, Germany says it's ready to support the EU's plan to ban Russian oil imports. The country's economy minister, Robert Habeck, made the pledge at a special meeting of energy ministers in Brussels yesterday.
After 2 months of work, I can say Germany is not against an oil ban on Russia. Of course, it is a heavy load to bear, but we are ready to do that.
Well, Germany's economy minister there, Robert Habeck, at a special meeting of energy ministers in Brussels yesterday. Now, he was speaking to our Maria Tadeo. He's been covering, of course, the meeting and joins us now. Maria, the Germans no longer oppose an oil embargo. How fast could we get some kind of meaningful embargo?
Yes, Francine, and you heard it in that clip. He was very explicit. He came out and said it openly. We've done the contingencies. We've worked on this for 2 months, and we're not going to oppose this embargo anymore. What I would say, Francine, is that, of course, you have to look at the figures that Germany put out on Sunday. Their oil dependency from Russia has dropped significantly since the start of the war. It was 35% before. Now it's 12%. So you can see that this is now doable from a technical perspective. In terms of when are we going to see this embargo happen? Well, Francine, there's a lot of questions still. We know that there's a number of countries, including Hungary, that say we're not sure this is going to put an end to the war. It will have a huge detrimental impact on our economy. And of course, this needs to be taken unanimously. Interestingly, Francine, there's another school of thought, too, that says, well, if this is a gradual embargo from now until the end of the year, Russia does make money on the price fluctuations, and therefore maybe it's better to tax it. So yes, there is a strong political signal from the Germans, but that doesn't mean there's consensus. For the time being, the reality is there isn't.
We've seen a scramble over the last few months from European leaders trying to shore up their energy supplies and looking to other nations. Now they're turning an eye to Africa. What is the reality around that, Maria?
Yes, and Tom, look, the Europeans say they want to cut down their gas dependency by 2/3 this year from Russia. This is a huge issue for them structurally. As you know, this is also difficult to do. It's not as easy to transport as oil would be. You need a whole lot of infrastructure. And now they're working to cut deals with countries like Senegal. They also point to Congo, Angola. They say there's a lot of untapped potential there. And this also feeds into a bigger conversation, Tom, that we see in Brussels about doing more deals with Africa to sort of push away the Chinese and their influence on the continent. And this is also happening, by the way, 2 days after that bombshell interview from Sergei Lavrov on Italian TV that was lambasted by European officials yesterday, now presenting Russia as almost a country that really doesn't respect history, but also is now entirely on a fake news planet.
Okay, trying to push out the Chinese in Africa. Well, they're a little bit slow on that one, aren't they? They're going to have to do a lot of work. China's and Africa have been focused on that relationship for over a decade. Maria Tadeo in Brussels, thank you. Let's get the Bloomberg First Word News now with Laura Wright. Laura.
Thanks, Tom. Politico reports the US Supreme Court is poised to strike down the landmark Roe v. Wade decision, which protects women's rights to abortion. Politico says it's seen a draft opinion written by Justice Samuel Alito, which has preliminary support from 4 other Republican-appointed justices. The 9-member court is scheduled to rule the case in July. Hong Kong is bringing forward reopening plans as COVID infections drop. From this week, masks will no longer be required for exercising outdoors. The city will allow dine-in at restaurants until midnight later this month. New virus cases are back at February levels as health officials say the 5th wave of COVID is now under control. BP has boosted its share buybacks by $2.5 billion as cash flow surged, offsetting some of the discomfort from a $25.5 billion charge linked to its planned exit from Russia. The London-based oil major comfortably beat analysts' expectations after what it says was an exceptional 3 months for its oil and gas trading businesses. First quarter adjusted net income came in at $6.25 billion, more than double the amount a year earlier.
We've got lowish stocks around the world. We've got lowish spare capacity around the world. And we have a lot of uncertainty in the market, quite frankly, whether it's with Iran, whether it's with Libya, whether it's with the global economy, whether it's with zero COVID in China. Lots of uncertainty. But I think if you step back from it, you'd say all of these things lead to a lot of volatility, and we can expect that volatility to continue.
Boris Johnson is to deliver a virtual address to Ukraine's parliament today, becoming the first world leader to do so. The UK Prime Minister will compare the Eastern European country's struggle to Britain's during World War II. In addition, his government has announced a new package of £300 million in military aid to Ukraine. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg Francine.
Laura, thanks so much. Laura Wright in London. Coming up, Citi says its London trading desk was behind the flash crash in Europe yesterday. It's a pretty crazy story. We'll bring you the details next. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
doesn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to the Open, everyone. We are 51 minutes into the European trading day. U.S. stocks actually fluctuating a little bit when it comes to futures. The FTSE down 0.2%, but the European stocks holding on to their gains about 0.5% higher. It's all about the Fed, what they do with the balance sheet. And then, of course, we have the Bank of England, Tom, also on Thursday.
We do indeed. Look, yesterday was traumatic, not just because you weren't here, but also traumatic was the trauma of not having Francine on set, but also the flash crash. And we witnessed this. At one point, you were down 1.9% on the stock 600, then suddenly you fall below 3%. This is what happened. Citigroup acknowledging that one of its trading desks was behind a flash crash in Europe, which sent shares across the continent tumbling. As I said, it caused equities in Sweden to briefly plunge 8%, which prompted the main European index to lose as much as 3%. Joining us now for more is our reporter, JP Barnett in Frankfurt. JP, what happened and what effect did this have on the markets?
Yeah, very good morning. I mean, it's like an amazing story, and this seems to happen like every other decade that we get these kind of wild market moves, and it shows you in what kind of a thin liquidity the market is right now. So what we know so far is that Citigroup obviously entered an order that was incorrect, or that has wrong size or wrong decimal. We don't have the details yet. And we think it was like more related to the Nordics, that order, at least from the data that we can see. And the interesting thing is that this had a ripple effect throughout the whole European market, at one point wiping out 300 billion for the stock 600, which is really amazing, because usually if you have a order that's wrongful in a local market and in a tiny market like the Nordics, then it stays there. It's very isolated. But again, it just shows you like how thin the liquidity is, how tight stops are operating, what algorithmic programs are doing right now, that a faulty order in such a local market could like spread all over Europe.
I mean, I have to say, JP, your screens behind you are just absolutely amazing. You're either like a billionaire day trader or maybe a flash crash maker. What are the, I'm kidding.
Or a Bloomberg reporter.
For Citigroup? Or a Bloomberg, a very good one as well. What does it mean for Citigroup?
Well, the interesting thing is, like, usually you should have safeguards for something like that, right? Some kind of a pop-up that tells the trader, are you sure you really want to do this? Obviously, that didn't happen. We don't know if it was a mistake or if the system didn't work or if it maybe was intent. We don't know yet. Remember, like back in 2020, Citigroup paid $400 million in the US for failing in risk management. So that's another bad reputation hit here for the bank. It already told us that it is in touch with the exchange and with the regulator, and I guess they will ask some hard questions why this happened, what they will do to prevent it. And I would say there's a high likelihood that Citi might have to pay a fine again.
So potentially a penalty. What other safeguards could be put in place and are being put in place around these trading desks to avoid these kind of fat finger trades?
I mean, usually, like, the system should do kind of a plausible check, right? If this makes sense, if you put in a zero too much or the decimal is wrong. I mean, granted, those banks, they are dealing with like big orders, and some of those can be like really like tremendous if some institutional customer is selling a lot of stock. But I mean, like, there should always be like kind of also a 4-eye principle when they enter a big order, just to make sure that everything is all right and that everything works like it is intended to, and to avoid that those orders like immediately are put into the exchanges and then cause those ripple effects. So that should be in place. Why it wasn't, hopefully we will learn later on.
JP, thank you so much. JP Barnett there in Frankfurt. We need to get back to like rate my room, because I give JP like a 15 out of 10 because that background is just so 15.
Good. I would have given 19 and a half. Fantastic. And fantastic insights into that flash crash yesterday as well. Futures, Francine, stateside, you're looking at gains of 0.3% across the S&P E-minis.
Yeah, I feel like they're swinging a little bit between gains and losses. Again, you know, you look at the Fed, you kind of look at what they're focusing on, a bit of earnings a bit later, but then we could see a huge move in treasuries after they hit 3% the 10-year yesterday. Yeah, we're seeing sell-off across the bond space here in Europe. Certainly the gilts, you're looking at yields higher by about 8 basis points across the 2-year. The German 10-year up 4 basis points. The 2-year over in Germany up 6 basis points. The 10-year above 1% in Germany for the first time since 2015. In terms of your BTPs as well, and we were talking, of course, to Scott Teal about this and whether or not there's anxiety around the peripherals. A 5 basis point move there on the Italian 2-year. Francine. Yeah, and of course, tomorrow it's Fed poised for its biggest rate hike since 2000. Well, that's it for the European Market Open. Surveillance Early Edition is up next. We'll look at markets. We'll also look at the flash crash. We'll look at that Lavrov interview, and we look at Russia. This is Bloomberg.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
If inflation doesn't break soon here, he's going to have to hit the brakes pretty hard. That will put us into a recession.
There will be an increase in rates, and central banks, have a narrow path to go down without harming the economy, but also neutralizing inflation, which is having, a negative effect on consumers.
I think people who have benefited from this extreme low rate, high liquidity environment where growth, all manner of growth have been rewarded. I think that's where the greatest correction will come.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Fed, day one, traders gear up for the central bank's biggest hike in 2 decades as the U.S. 10-year yield tops 3%, while the German equivalent hits 1% for the first time in 7 years. Energy agenda. The EU plans additional guidance on Putin's gas for rubles demand to lay out what companies can and cannot do under sanction rules. And Politico report reveals that the U.S. Supreme Court is poised to overturn the landmark Roe versus Wade decision protecting abortion rights. It could have a massive impact on U.S. politics and society. Now, good morning, everyone. First thing is first, let's check on the markets. Now, we're seeing a bond rout actually deepening, bonds around the world plummeting as investors brace for the biggest U.S. rate hike since 2000. If you look at European stocks, it's only the FTSE where we're still seeing a bit of pressure. Overall, though, we're seeing a nice little lift, getting some 0.6% across the board. If you look at U.S. futures, there's a bit of a fluctuation. Banks being supported certainly by BNP Paribas results. That's because the volatility means that they made a bit more money when it comes to their trading units. But this is where the real action is. The German 10-year bond and the 10-year yield in the U.S. Again, the 10-year yield in the U.S. actually trading 3%. After hitting that milestone yesterday. It has huge implications for the whole read across, also among stocks. Australian bonds, also something that we need to watch out for. Still sliding the currency jump after the nation's central bank increased borrowing costs by more than many had expected. So if we go to the central bank conundrum, we look at ECB and Bank of England. We do have the Bank of England on Thursday. The FTSE, you can see here in the UK, the only one that's down some 0.2%. Otherwise, for the moment, we have energy on the way up, and that is giving a lift to some of the commodity rich, including, for example, CAC 40. I'm not sure why the FTSE actually is down some 0.2%, but certainly something that we need to keep an eye on ahead of the Bank of England on Thursday. So let's get into some of the key market drivers with our markets editor, Christine Aquino. Christine, first of all, what lessons can the Fed actually glean from the RBA's experience in delivering this supersized rate hike?
Well, Francine, I think the RBA was really delivering a masterclass in the elements of surprise here. This was something that traders and investors really did not expect. The fact that they were going with a bigger than expected rate hike, as well as forecasting potential future rate hikes, given that path of inflation that they flagged during the meeting. So this is quite a difference from what we've seen from the Fed, right? We've heard policymakers, Jay Powell himself, time and time again, flagging that potential for a 50 basis point rate hike this coming Wednesday. And so a lot of that potentially, arguably, is already priced in. I do wonder what sort of impact the Fed will have once we finally see that 50 basis point rate hike come into reality. And is there potential here for the ramp up in yields to stall? I know that we hit that key 3% level. Is there potential for yields to pull back, at least in the short term?
Yeah, and also, I stand corrected, the FTSE, of course, catching up because yesterday it was closed because of bank holiday, which explains that little bit of differential, Christine, between the FTSE down and everything else in Europe getting some 0.5%. So how does this all play into some of the yields and key thresholds for various markets? Is there a potential for sell the rumor by the fact after some of these rate decisions?
I think, Francine, there is very much potential for that, especially because, again, you know, we've seen policymakers really telegraph this move. The Fed, in particular, really telegraphed this move that we are about to see. I think it would be a bigger surprise if they suddenly decided that 50 basis points was not on the table after all. And so, you know, that would probably have more potential to cause disruption rather than a 50 basis point rate hike itself. And so I think, given the momentum that we've seen, I mean, today we're hitting those key levels on 10-year Treasury yields, 10-year bond yields, 3-year Australian yields. I think there really is an argument here for a bit of that momentum to slow, especially once we get confirmation of those rate hikes later this week.
Christine, what can you tell us about some of the earnings? So depending on whether you have exposure to Russia's, such as BP, there's a clear divergence.
Absolutely, Francine. It turns out that Russia appears to be quite a key differentiator for this earnings season. Again, BNP benefiting from all that volatility that ensued from the Russia turmoil at the start of March, late February. But, you know, that was something that the bank really benefited from when it comes to those trading volumes. Then, of course, on the other hand, you had BP, which had to write down nearly $26 billion because of its exit from Russia. But it's still benefiting from the higher oil prices because, of course, we're still talking about this potential crunch in the energy supply as the Russia geopolitical tensions continue.
Christine, thank you so much. Our markets editor there, Christine Aquino. Now, Fed officials will meet later today with a decision on U.S. monetary policy coming tomorrow. Ahead of that, the sell-off in Treasuries boosted the yield on the benchmark 10-year note to 3% earlier today for the first time in more than 3 years, while top investors at the Milken Institute conference discussed rising inflation in the U.S.
If inflation doesn't break soon here, he's going to have to hit the brakes pretty hard. That will put us into a recession.
I think people who have benefited from this extreme low rate, high liquidity environment where growth, all manner of growth have been rewarded, I think that's where the greatest correction will come.
It is simply unfeasible for economics or economies, for human beings and their livelihood and well-being, to shut down the fossil fuel industry. And I think we're seeing this live in Europe with the Russian crisis.
If the inflation is transitory, if we are heading towards a 4% rate by the end of the year, he has a lot more room to maneuver rates in 2023.
Well, we're now joined by Henrik Johnson. He is co-head of capital markets at Deutsche Bank. Henrik, thanks so much for joining us. First of all, I mean, you have a unique insight into what clients think, on what they worry about. Are they worried that they don't have visibility going ahead because of inflation and monetary policy, or do they actually think a recession's coming?
I think, well, I speak to a lot of corporates especially, and I have to say, you know, the consensus is while earnings so far have been good, as you've reported, the outlook is pretty dire. And from an issuance perspective, what we're seeing is that investment-grade issuers, who are obviously priced on spread, are issuing as much as they need and going ahead, and investors are receptive. But, you know, other products, which are more yield-based, are a bit tougher. Understandably.
So what are they worried about? Going ahead, is it inflation? Is it a monetary policy mistake? Or is it actually a recession because of monetary policy?
I think people see a recession coming down the pipe. And you know, it's going to be a very difficult challenge for central banks to engineer the soft landing that they want. So, you know, while obviously we're hoping that the central banks manage to hike rates appropriately to cool the economy globally, there's some real downside risks, especially here in Europe from the Ukraine. So I'd say, you know, most people are pretty conservative.
I mean, this is a huge calibration, right? Do they worry that this will be a self-made recession, so that we hike too much, that actually the Fed, the Bank of England, the ECB look at inflation, freak out, they hike, and actually forget the economy?
Well, at the same time, you can't let inflation go out of control. So, you know, I don't envy them their jobs. But, you know, I think the sort of the rate of the hikes that are currently priced in, you know, accord with our view at DB. And, you know, I think the central banks are going to have to be reactive. You know, they're going to see what CPI does, you know, what stock markets do, and then they'll try to calibrate. But it's not going to be easy.
I mean, are your clients worried that they're reactive, where they should be ahead of the curve?
I mean, look, I think no one's really... no one has a crystal ball to try to forecast what the central banks do, but you know, you are seeing companies gather liquidity to insulate themselves from a potential recession. You know, and there's a lot of hedging going on as well. There's FX volatility, so you know, I think a recession certainly isn't a certainty, but the risks of it have gone up a lot in the last 3 months, especially since the rise in energy prices because of the Russian invasion of the Ukraine.
Henrik, when you look at some of your clients, I know you can't talk about them specifically, but is there a sector where they're feeling most pain compared to others? When you look at earnings, some of them, of course, have, you know, are able to pass on some of the costs. They still have inventory that's quite low and high margins.
Yeah, I'd say, yeah, it's a mixed picture, and there's winners and losers in every sector. But I'd say in general, retail clients, you know, are directly exposed to the consumer. You know, they're probably the ones that are focusing very much on cutting costs. And something that they're all doing, which is actually interesting, it hasn't been required for many years, is how do you get your organization to actually pass on price increases when no one's been in an inflationary environment? So even at sort of lower down in the organizations, in the sales teams, you have to tell them, no, you have to raise prices, and you have to raise prices again. And you know, no one's had to do that for 10 years, and that's a challenge.
So the challenge is what, mismeasuring it, or then selling it to the end consumer?
It's actually incentivizing the sales teams to push through against obviously some resistance from their customers. But if you don't get ahead of the inflation as an organization, then your margins are going to suffer, and you know, your results will therefore, you know, be poor relative to your competitors. So you know, it's almost a behavioral shift. It's the same in financial markets. Very few people have been in this kind of rising rate environment, you know, for the last 15 years. And so it's a challenge for investors as well. How do you trade a potential 150 basis point increase in the Fed fund rate? It's a big challenge.
Big challenge, and then of course you worry that if you increase your prices too much, then they change brands. Henrik, that's the conversation we'll have next. Henrik Johnson, there, co-head of capital markets at Deutsche Bank. He stays with us. Coming up a little bit later this hour, we talk global supply chain disruptions with the Interos chief executive and founder, Jennifer Biscaylier, and the chief executive officer of Improbable, Herman Narula. You can join us. You can tell us about selling virtual land in the metaverse. Well, actually, you can ask me questions to ask them. That will make everyone smarter. Or don't. This is Bloomberg.
Wednesday, a Bloomberg exclusive. JP Morgan Chase Chairman and CEO Jamie Dimon speaks with Bloomberg's Francine Lacqua, live from the JP Morgan CEO Summit in London, only on Bloomberg TV and radio.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's focus on the trends within M&A and equity capital markets. By the beginning of April, at least 100 companies worldwide had delayed or pulled financial deals worth more than $45 billion. Now that was since Russia's invasion of Ukraine. The conflict has roiled funding markets, hurt investor appetite for risk, and increased uncertainty over growth, interest rate hikes, and supply chains. Well, we're back with Henrik Johnson. He is co-head of capital markets at Deutsche Bank. Henrik says he sees decent equity capital market performance in the second half of the year, despite the impact of Russia's war in Ukraine. Is it going to be, Henrik, and we'll talk a little bit more about inflation because we're having a great conversation on inflation. How difficult is it for us as the sales force to realize that they need to pass on some of these increasing pressures? But overall, do you think there's pent-up demand of deals wanting to be made that were kind of stopped in the beginning of the year because of the war in Ukraine that will pick up at the end of the year?
Absolutely, and it's driven by the fact that there's a massive disconnect between private and public markets. So in the private markets, there's still plentiful liquidity, both in private equity and in the direct lending setup, and you haven't seen the adjustments of valuations there, but you have seen the adjustments obviously in public equity markets and debt markets. And so what we're working on, and our competitors are as well, is a lot of public to privates, as some of that private money looks at things that they haven't been able to afford before, and now valuations have come way down, and so opportunistically they're making some bids, and I think that's going to be really the driver of M&A in the next few quarters.
I mean, there's something incredible, and we have a chart illustrating the fact that 10-year yield actually touched 3% yesterday, or in the early hours of last night, like just a couple of hours ago. And I don't know whether that will be more symptomatic of a shift into some of these private markets, or how you see all of this cheap money out there changing hands over the next 12 months.
Well, the question I think for the alternative asset managers is, will they be able to fundraise at the same pace as they have when the risk-free rate is much higher? Because obviously a lot of their attractiveness of their product has been because it's been a way to generate returns for savers, insurance companies, and so on. I think they would argue that in treasuries, your real rate is still going to be negative. Yeah. And so by investing in alternative assets, you actually lock in a sort of a positive net return. But I think time will tell, and some of the froth has come off the market for sure.
So how much time do you need to tell? Is it 6 months, or could this be a longer-term trend that would take 18 months?
We're in the middle of a massive private equity fundraising cycle right now. Yeah. Virtually every company is out there trying to raise a big fund. And the results will start dropping in the next few months, I'd say, before the summer to see, is it a 30 billion fund? Is it 25? Is it 20? That would be bad. So that'll be an immediate way to tell. And then also, is there going to be pressure on private marks, to be adjusted down as well, which will make everyone a lot more risk averse. Henrik,
are SPACs still a thing? Because there's so many, of these special purpose vehicles that still need to find a target.
A lot of people ask that, and obviously SPAC issuance is definitely not a thing. But the SPACs that still exist, many of them, the clock is ticking on them finding a target. And actually, ironically, with the adjustments in public equity markets, they've suddenly become a lot more attractive, to investors because you're able to lock in a better valuation. So I wouldn't count out the SPAC M&A market just yet.
Okay, interesting. In what sector across the board, or is there a specific sector that you think will be?
It's quite tech heavy still. Yeah.
As always. It's always tech heavy, isn't it, Henrik? Thank you so much. Henrik Johnson, their co-head of capital markets at Deutsche Bank. Now, coming up, we'll bring you some of our conversation with Santander Executive Chair Anna Botín. Don't miss that. This is Bloomberg.
Airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
However you get your news.
This is Bloomberg Daybreak with Link.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Both Europe and the US had a big amount of savings accumulated. So the numbers are between 1 trillion in Europe to 2.5 trillion in the US. So the consumer is in a pretty good state for now. Obviously, they're beginning to suffer the increase in energy prices more in Europe. But we see still, if you compare year on year, the consumer is strong, including in the US, also in Europe. Where we see a bit of weakness is in the investment from corporates. So I think that's where we have not seen a pickup as we would expect. But we believe that should happen because there's a bigger demand to have that supply chain closer to home. Energy companies having to finance working capital, and that is also a bigger demand for credit. So I'd say consumer strong, no signs of weakness yet. On the corporate and commercial side, not as strong as we would like.
Well, that was Santander's Executive Chair Anna Botin speaking exclusively to Bloomberg's David Weston on how the consumer is holding up against sky-high inflation. Now, BP has also expanded buybacks after exceptional trading performance. We've also been speaking with the Chief Executive, Bernard Looney.
The oil markets in many ways are a little bit more straightforward to resolve than the gas markets. The oil market's a much more global commodity, and a lot of those cargoes of oil provided seaborne cargoes, so to speak. So it's a slightly less challenging problem than natural gas, but it nonetheless presents challenges. What we've seen to date in the energy markets are about 1 million barrels a day of Russian crude off the market. That may double, Anna, this month when sanctions come truly into effect, and that's before the sanctions that we're talking about right now. We've got lowish stocks around the world. We've got lowish spare capacity around the world, and we have a lot of uncertainty in the market, quite frankly, whether it's with Iran, whether it's with Libya, whether it's with the global economy, whether it's with zero COVID in China. Lots of uncertainty. But I think if you step back from it, you'd say all of these things lead to a lot of volatility, and we can expect that volatility to continue. And at the same time, I think we can expect prices to remain strong, I think, for quite some time.
Well, that was the BP Chief Executive Bernard Looney speaking with our Anna Edwards on the stock price, gaining some 3.2%. Now let's get straight to the Bloomberg First Word News. Here in London with me is Laura Wright. Hi, Laura.
Good morning, Francine. Politico reports the US Supreme Court is poised to strike down the landmark Roe v. Wade decision, which protects women's rights to abortion. Politico says it's seen a draft opinion written by Justice Samuel Alito, which has preliminary support from 4 other Republican-appointed justices. The 9-member court is scheduled to rule in the case by July. The European Union is to provide more detailed guidance in the coming days on what companies can and cannot do under EU sanctions rules to address Russia's demands to pay for gas in rubles. Energy ministers from the bloc met yesterday in Brussels to discuss the problem. Separately, Bloomberg has learned the EU plans to look to African nations for more liquefied natural gas to help replace Russian supplies. Hong Kong is bringing forward reopening plans as COVID infections drop. From this week, masks will no longer be required for exercising outdoors. The city will allow dine-in at restaurants until midnight later this month. New virus cases are back at February levels as health officials say the 5th wave of COVID is under control. Citigroup says its London trading desk was behind a flash crash in Europe yesterday. The brief blip sent shares across the continent tumbling after a sudden 8% decline in Swedish stocks. The US bank says one of its traders made an error when inputting a transaction, but it was corrected within minutes. Boris Johnson is to deliver a virtual address to Ukraine's parliament today, becoming the first world leader to do so. The UK Prime Minister will compare the Eastern European country's struggle to Britain's during World War II. In addition, his government has announced a new package of £300 million in military aid to Ukraine. Italy has raised its windfall tax on energy industry profits from 10% to 25%. That's as it approves a €14 billion package to shore up companies and consumers hit by surging costs. Rome has already taken significant steps to reduce its reliance on Russian gas supplies, which account for around 40% of gas imports. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg, Francine.
Laura, thank you so much. Coming up, we talk China. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Fed, day one, traders gear up for the central bank's biggest hike in 2 decades as the U.S. 10-year yield tops 3%. The German equivalent hits 1% for the first time in 7 years. Energy agenda. The EU plans additional guidance on Putin's gas for rubles demand to lay out what companies can and cannot do under sanction rules. And a political report reveals the U.S. Supreme Court may overturn the landmark Roe versus Wade decision protecting abortion rights. It could have a massive impact on U.S. politics and society. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, first, let's check on the markets, and we're holding on to gains. If you look at U.S. futures, though, a bit more of fluctuation when it comes to gains and losses. Now, when you look at the European Stock 600, getting some 0.7%, a lot of it is earnings. A lot of it is also this bond route deepening, rate hikes looming, and stocks, for the moment, holding on to some of those gains. Now, the U.S. 10-year yield trading near 3% after hitting that milestone on Monday, currently at 2.9927. Meanwhile, investors also betting that global bonds are still expensive and taking shelter in equities in today's trading session. Now, the global economy is currently suffering an unprecedented series of supply chain shocks, the pandemic, along with geopolitical tensions, and in particular, the war in Ukraine. They're placing further strain on the already fragile and very complex supply ecosystem that forms the backbone of world trade. Well, one company that seeks to manage risk and increase operational resilience in the supply chain realm is Interos, and we're joined by its chief executive and founder, Jennifer Bisceglie. Thank you so much, Jennifer, for joining us. First of all, talk to us a little bit about Interos. I mean, this is an amazing company. You track supply chain, so you can tell me, because of the war in Ukraine or because of COVID and the way that China is dealing with it, this many suppliers in the U.S. will be affected. How has the war in Ukraine changed the game for the next couple of months?
Well, thank you for having me. And I think the biggest thing to remember about what's happening with the war with Ukraine is simply the human toll. It's profound. And millions of people have been impacted, from refugees to homebound workers, which has forever shifted and expanded the supply chain. And if you couple that with the fact that right now in the court of public opinion, companies are literally being judged by the health of their supply chain, having the right product to the right place at the right time for the right price. You know, most companies and most supply chains simply were not built for the kind of volatility that they're experiencing right now.
Jennifer, why do you need AI to try and track some of these? How difficult is it for a big company, or actually for, you know, economists, but also investors, to see where the supply chain starts and ends?
You know, I really think the game today is around transparency. And transparency isn't necessarily a cure, but it's definitely preventative medicine, meaning that having that total visibility, as you just mentioned, not only is it hard, but nobody was really asking these questions. We were so focused on leaning out the supply chain and cutting costs and getting just in time in place that we really weren't focused on the total visibility needed, not just for your primary supply chain, but as you mentioned, for your tier 2s, your tier 3 suppliers and beyond. And by having this transparency, you're now able to identify risks and model ahead future problems, which is really where the winnings happen.
So how complex has the world gotten, Jennifer, in terms of supply chains? And did President Trump do us a favor in shifting these supply chains 5 years ago when no one was really expecting it to be beneficial longer term?
Well, I think the shifts have been happening for many, many years. And I think when you look at the pandemic, that forever changed the supply chain, just sheerly pushing us all into our homes. And we're all starting to order hard goods at a pace never experienced before. And it actually, the supply chains just couldn't handle it, which we're still trying to dig out from that. Then you have cybersecurity breaches like SolarWinds, or you have the Ukraine situation, or you have the Suez Canal and the ship going sideways. So they're complex. They're hyper-connected. Technology has done this to us, and it's never going back. So this is the new normal, and that's where we go back into mapping the supply chain, monitoring, and then scenario planning and modeling is really what's going to make businesses not have this whack-a-mole approach to and being reactive to problems in their supply chain.
So how many U.S. firms have links to second-tier suppliers in Ukraine right now, Jennifer? And how difficult is it to readjust some of these supply chains? I mean, we're speaking to the chief executive of Unilever, and they were saying that, for example, some of the cooking oil that they use in certain products have had to be replaced with other ones.
Yeah, it's hard because there's only a certain amount of companies that make a certain amount of things in the world. But based on the analysis that we've been able to do at Interos, there's well over 100,000 companies just that are sourcing in their top 1, 2, and 3 tier suppliers from Ukraine right now that they have to look for alternative sources. And that's a massive shift. And you also have to think that if your company is making a shift, your competitors are as well, which is why getting ahead of the problem is so important. I also think, if I could mention, the next thing we're all looking at is China, the situation with Shanghai and Beijing. And if we had over 100,000 firms for Ukraine, Russia, we've modeled over 300,000 firms that have connections into that part of the world. That's a real situation, and that's across retail, machinery, and automotive.
But Jennifer, given the animosity of the Trump administration with China, did a lot of these supply chains not change? So are we, I guess, less reliant on some of these Chinese suppliers than we were 4 years ago?
So the supply chain isn't a political situation. It's really just where are those products and those skill sets available for me to get what I need to get onto the store shelves. And so for all the reasons that we all know, China actually took a forward step in investing in technology, made it very attractive for companies to go and manufacture over there, and then actually had skilled workers and laborers to produce the product. So that's where the supply chain was. And you're now seeing, based on sanctions in Russia and based on the concerns in China, you're now seeing a lot of countries mapping their supply chain and trying to figure out how to unhook and find other parts of the world where those raw materials and skill sets exist.
Yeah, I mean, if you have tariffs, though, that were put in place on Chinese products coming into the U.S., I imagine that would have focused the minds of certain investors in getting away their supply chains from China. First of all, Jennifer, do you have first mover's advantage then if you find some of these supply chain, quirks or the fact that it's not going in the right direction in certain cases? And if you change supply chains, is it automatically inflationary? Because if you bring them back home, it's going to be more expensive.
So a couple great questions there. I do think that the first mover's advantage, the companies that are investing in the transparency and the mapping of the supply chains are absolutely going to win for no other reason that they will actually have the product they need in consumers' hands faster. Not only that, but they'll actually be able to invest and choose how much they're willing to pay for it, which keeps the costs down when the consumer does go to the store. So I do think first mover's advantage, investing in technology, mapping the supply chain is really going to win the day. As far as bringing things home, I do think there's only a certain amount of places in the world that there's skilled workers, there's raw materials, and the supply chain lines up, and that's just the situation.
All right, Jennifer, thank you so much. Jennifer Bisciglia there, the Chief Executive Officer and founder of Interos, talking about supply chains, of course, China and Ukraine. Now, we're just getting some breaking news out of Russia. Russia Eurobond funds, we understand, has been processed by at least one clearinghouse. Now, from earlier today, we had been briefed by our reporters that Russia had just over a day to get some of these payments on 2 foreign bonds to investors and dodge a default in a closely watched struggle with sanctions. So for the moment, we understand that they have been processed by at least one clearinghouse. We'll have plenty more, of course, on Russia being able to avoid a default potentially for another day. The clearinghouses are charged with then distributing the cash to investors' accounts. So they're kind of the oil in the mechanism. It could mean that the money will get into the accounts that they need to reach. Coming up, protesters rushed to the U.S. Supreme Court after political reports that the court is set to overturn abortion rights. We'll get the latest on that shortly. This is Bloomberg.
Wednesday, a Bloomberg exclusive. J.P. Morgan Chase Chairman and CEO Jamie Dimon speaks with Bloomberg's Francine Lacqua, live from the J.P. Morgan CEO Summit in London, only on Bloomberg TV and Radio. Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, political reports the U.S. Supreme Court is poised to strike down the landmark Roe versus Wade decision, which protects women's rights to abortion. Politico says it's seen a draft opinion written by Justice Samuel Alito, which has preliminary support from 4 other Republican-appointed justices. The 9-member court is scheduled to rule in the case by July. Let's get more now with our reporter, Bruce Einhorn. Bruce, first of all, this is an earthquake when it comes to civil society. How divisive will this be in the U.S.?
Well, abortion, of course, is one of the most hot-button issues in the U.S. in culture wars. There is strong support in the U.S. polls show for abortion rights. So a majority of Americans do not want to see Roe v. Wade overturned. That said, the base of the Republican Party is very supportive of getting rid of abortion rights. So this will likely just intensify the culture wars that we already have raging in the U.S.
So, Bruce, what does this mean for the midterm elections?
Well, we already know that Republican voters were extremely motivated to vote in the midterms. Typically, that's what happens. The out of power party typically does very well in midterms. The key thing that could happen here is that suddenly now there are going to be a lot of Democratic voters potentially who are very concerned about abortion rights, who will be motivated to vote, who might not have been in the past. So this does have the potential to really make the Democrats suddenly more competitive in midterms that otherwise were looking pretty down for them.
Bruce, why was this leaked? It feels like it's very unusual to actually get a leak in this kind of decision.
Yeah, it's extraordinary to have a leak like this. It just does not happen. The Supreme Court just doesn't leak. And we should be clear that we don't have any verification that this is authentic or not. So we have to go with what Politico is reporting. That said, though, it does seem to be genuine. And if it is something that we just haven't seen in decades, if ever, really, to have a full opinion, draft opinion leaks like this.
Bruce, thank you so much, as always, for giving us up to date or bringing us up to date with this huge story, Bruce Einhorn. Now let's get straight to your Bloomberg Business Flash. Here's Laura Wright. Hi, Laura.
Hi, Francine. BP has boosted share buybacks by $2.5 billion as cash flow surged, offsetting some of the discomfort from a $25.5 billion charge linked to its planned exit from Russia. The London-based oil major comfortably beat analysts' expectations after what it says was an exceptional 3 months for its trading business. First quarter adjusted net income came in at $6.25 billion, more than double the amount a year earlier.
We've got lowish stocks around the world. We've got lowish spare capacity around the world. And we have a lot of uncertainty in the market, quite frankly, whether it's with Iran, whether it's with Libya, whether it's with the global economy, whether it's with zero COVID in China, lots of uncertainty. But I think if you step back from it, you'd say all of these things lead to a lot of volatility, and we can expect that volatility to continue.
BNP Paribas has reported a surge in both equities and fixed income trading. France's biggest bank joined peers in benefiting from market gyrations amid energy price spikes and Russia's invasion of Ukraine. Markets revenue jumped 53% to 2.8 billion euros, well ahead of estimates. A brief bout of concern regarding Alibaba's co-founder Jack Ma triggered wild swings in shares of the e-commerce company earlier today. Alibaba plunged as much as 9.4% in Hong Kong after state broadcaster CCTV reported authorities had imposed curbs on an individual surnamed Ma in the company's hometown. The stock rebounded after police indicated the accused person's name was 3 characters. Jack Ma's Chinese name is the 2-character Ma Yun. Citigroup is in active dialogue with potential buyers of its consumer and commercial banking operations in Russia. CEO Jane Fraser also said the financial sanctions on many of Russia's largest banks could thwart Citigroup's efforts to exit its operations in the country. That's the Bloomberg Business Flash. Francine.
Laura, thanks so much. Coming up, we speak to the improbable Chief Executive Officer, Herman Narola, shortly. We talk about the metaverse, and of course, we talk about how you dive into it. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, on Saturday, sale of virtual land in the metaverse Other Side raised about $320 million worth of cryptocurrency in the largest offering of its kind. Demand was so strong that activity related to the event caused ripple effects across the entire Ethereum blockchain, disrupting activity and sending transaction fees soaring. Well, we're now joined by Herman Narula. He's Chief Executive Officer and co-founder of Improbable. It's a British metaverse technology company that had partnered with Yuga Labs, the creators of the Bored Ape Yacht Club, to develop its metaverse offering. Herman, thank you so much for joining us. I have a lot of questions in terms of what kind of technology we need, when do we see the metaverse, and if there's a first mover's advantage, right now to try and get into the metaverse. So first of all, if I'm a big company, let's say I'm an imaginary big drinks company, what do I do to make sure that I don't miss out?
So I think it's worth starting with what's the opportunity for a company like that. And for me, it's really simple. The metaverse is about engaging thousands, even millions of people in interactive activities that enhance their sense of connection to each other and to whatever activity you're promoting. So a great example of where the metaverse is going to be incredibly important is sport. Yes. If we can start to put stadiums full of thousands of fans around the world into virtual spaces, it's just going to grow the engagement of sport.
And Herman, you're doing that technology, right? To be able to basically have around 10,000 people online at the same time.
Yeah, it's actually about 15,000 people now. Yeah, and not just online at the same time, but uniquely, our technology allows those people to be in the same spot. So if you want to get a sense of what that means, the megahertz of the metaverse, kind of like the technical power needed to make it run, is a metric called messages per second or operations per second. So a game like Fortnite does about 10,000 operations a second. WhatsApp does about 1 million messages globally. But to do what we do, you need to do about 1 billion operations a second.
So Herman, so basically Fortnite, because you can only be around 100 players at the same time, right?
Exactly.
So you have to, so what kind of technology is it? Do you have the technology, or is it still something that you need to make it happen?
We've actually developed and production tested this now with events involving thousands of people all over the last year. So what we've had to do is build an operating system that can handle thousands of different players all connecting to the same system and managing all of the communication between them. That's kind of the challenge.
Does regulation come in?
At a certain stage it will, because we see a lot of digital assets becoming a big part of the metaverse, right? And so when people are engaging with things that are financial assets, I think at a certain stage, it's going to be important that regulation comes in.
But Herman, so is it your technology that you'll be able to use, or do you think you'll have to share it with other players?
So what we've chosen to do is actually build an independently governed network called M Squared, which takes our technology and actually connects together the worlds of different companies and allows them to work together. And we're taking quite a different view on that, which is we eventually would like that to be controlled not just by us, but actually by the users.
I was looking at some of the revenue opportunities, and various analysts say it's about $800 billion by 2024. 2024 is around the corner. Who's gaining the most right now?
I think a lot of people are going in the wrong direction with it. They're looking at it as an extension of gaming. I think the most exciting stuff happening is when you combine crypto with the metaverse. So obviously, as our partners, I believe strongly in Yuga Labs and their project with Otherside, but I do think there are other great projects out there too.
But so what does that look like? And actually, how quickly will that be adopted in your eyes? Like if you map out the timeline of how you see this developing.
I think 2024 is a bit too fast to imagine an $800 billion opportunity, but I do see a fast timeline. I think what we're lacking right now are experiences that ordinary people can use immediately and that give them the chance to have something they couldn't have in a normal video game or a normal experience. And that's what I hope we're bringing to the table.
You're also a newly minted author, almost an author, right? Because you're writing a book on why we need the metaverse. What do people misunderstand about the metaverse?
I think people misunderstand that it's about technology. Our society is already full of living ideas. Culture, sport, history, religion, music. These are all ideas that enrich our everyday lives. And my argument is that the metaverse is just an extension of that. It's just taking those things, infusing them with technology, and giving us the chance to have a greater participation in that cultural world.
Do people and companies that don't think about the metaverse now, do you think they'll be left out of it? Is there definitely a first mover's advantage?
I think it's worse than that. I think it's almost a cull of businesses that think of their customers as consumers versus businesses that understand that their customers are going to become interactive participants in a world that they create. And I think the companies that don't get that are just going to be drowned by the ones that do.
But Herman, is this a little bit like, when there was a shift to mobile?
Exactly.
It's going to be an even bigger earthquake for the companies that don't adopt it?
It's more like the internet. It's that fundamental. Yeah. It's an entirely new medium in which people have to develop new business models, new ways of engaging users, new ways of understanding what they want.
But on the internet, at some point, everyone's on it or otherwise, or I don't know how much time a big company or a small company actually has to get on board with this before they fail.
Yeah, I think you have to be working on this problem right now. I can't imagine a large business, especially a consumer-facing business, shouldn't be making preparations today on how they're going to engage audiences in the metaverse, who they're going to partner with, what they're going to do to support a digital asset economy. And it applies even to things like sports. Some leagues are ahead of others, right, in getting crypto and metaverses involved.
What's the craziest conversation you've had with, like, I don't know, a boomer owner of a company that says, well, the meta what?
There are some pretty wild ones, but I'm surprised at how progressive people are, to be honest. Mostly what I'm encountering in boardrooms is fear. It's not a sense that, oh, this isn't for me. It's more, oh, God, am I going to miss out? Because I think companies have been through the cycle of social media, really wrecking that, their ownership over the user, changing new business models, and I think people don't want to miss out again.
And this is true for European founders, or is there, more of an early adoption in the U.S. because there have seen more disruption?
Yeah, there's a bit more there's a bit more of a forward-looking mindset, I think, in the U.S. companies we've spoken with. There's probably a lot more U.S. business coming our way than European at the moment.
Great. And your book is out in October?
Couple months, October, yeah.
World exclusive, right?
Oh, absolutely.
Right here, of course. Herman Narula, thank you so much, Chief Executive Officer and co-founder of Improbable. Now, this is the picture for the markets. A lot of the focus, of course, that 3% 10-year yield that we touched in the early hours of today. Look out for that. We also have quite a lot of earnings news. Russia poised to dodge default. This was the big story that we broke about 15, 20 minutes ago. Russia's closely watched dollar payments on 2 bonds, moving ever closer to creditors as the country's still racing to unblock the transfers and avoid a default. So Bloomberg Surveillance Early Edition continues in the next hour. Kriti Gupta, Katie Lyons in New York, or Anna Edwards here in London. The focus will firmly be on treasuries, the picture also on what we're seeing with bonds. Bond rout deepening, bonds in fact plummeting around the world. Investors bracing for the biggest U.S. rate hike since 2000. Yes, tomorrow's Fed day. Today's the first Fed day, but tomorrow we found out what they did, and it's a wave of policy tightening by other central banks that will maybe push it to go further. This is Bloomberg.
nuestro estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Risk on, risk off doesn't exist anymore now. It is risk on, and lately risk off, risk off.
It has been a brutal market. Certainly April and the start of the whole year so far has been brutal. But it is an important reset. We are in a different environment. Interest rates are going to be rising.
I think right now, front and center for them is taming inflation.
We are better off running the economy with a slightly higher risk of inflation.
Everything that you believe prior to 2008 no longer exists.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Tuesday, May the 3rd. Our top stories today. A report says the U.S. Supreme Court is set to overturn the landmark Roe versus Wade decision, which has protected the constitutional right to an abortion in America. That could reshape the battle for control of Congress this fall. Bonds plummet as investors brace for the biggest U.S. rate hike in more than 2 decades. Billionaire Ken Griffin says the Fed needs to keep inflation at 4% this year to avoid a recession. And Citigroup takes the blame for the flash crash. The bank says one of its traders made a mistake while inputting a transaction that roiled European stocks yesterday. Welcome to Bloomberg's Surveillance Early Edition. I'm Anna Edwards in London with Kaylee Lines and Kriti Gupta over in New York. Matt Miller is off today, and it is a central bank heavy for us to focus on this week. Kaylee.
Yeah, it absolutely is. And of course, this week also a little bit lighter in terms of trading in Asian equities because you still have holidays in places like China and Japan closed today as well. Hong Kong was open for trading, though, and one individual stock in particular was really in focus. That would be Alibaba. You had CCTV, China's state broadcaster, reporting overnight that authorities in Alibaba's home base of Hangzhou had imposed curbs on an individual whose surname was Ma. Investors got really worried that that was Jack Ma, the co-founder of Alibaba. As a result, sent the shares down as much as 9.4% interday, at one point erasing $26 billion in market value. Then police from Hangzhou said that the individual's surname had 3 Chinese characters, unlike Jack Ma that just has 2 Chinese characters, so then erased a lot of those losses, only ended the day down about 1.8%. But it really just underscores how worried investors are in China about any kind of regulatory crackdown within the tech sector. And of course, investors also worried about that persistent COVID-0 policy, which we continue to monitor. Beijing now halting in-person dining in restaurants until the end of the May Day holiday. At least that, of course, ends tomorrow. You're seeing a persistently weaker Chinese yuan at 668 or so, at the weakest against the U.S. dollar going back to November of 2020. But elsewhere in FX, the big outperformer on the day, That would be the Aussie dollar, stronger by about 0.7 to around 71 cents on the dollar or so after the RBA delivered a larger than expected rate hike, 25 basis points. Economists were only expecting 15 basis points. Really underscores an aggressive central bank, not just in Australia, but really around the world, push to rein in inflation. And also as a result of that, in addition to the stronger Aussie, huge move in the short end in Australia, up 20 basis points on the 2-year, 2.755% is where we sit, Creedy. That is the highest going all the way back to 2014.
Yeah, well, Kaylee, a little bit of a risk-off mood here in the United States, or I should say risk-on, but really just marginal. The concern is that it will turn risk-off. After all, tomorrow we are waiting for the FOMC, so a lot of the markets here, a lot of investors going to be in wait-and-see mode. And traditionally, if you look historically, the day before any FOMC meetings tends to be a risk-off day, and we're already kind of seeing perhaps hints of that in the cross-asset picture. Futures about flat right now. The 10-year yield also flat, so once again, not a ton of movement, even as pre-market trading does kick off. A little bit of a negative tone in the crude picture, really ongoing from that China story Kaylee was just talking about, down about 0.9%. But once again, in a volatility context, that is still not a huge move to the downside. Let's see, though, if it worsens. Even Bitcoin, a marginal move upwards, 0.5%. Whether it can sustain into regular trading, Anna, that is the question.
Yeah, that's one of the questions, Chrissy. We have here in Europe a fairly mixed session taking place, but overall the sense is that we go a little bit higher here this morning here in Europe. European stocks in particular to the south of the continent doing pretty well, up by more than 1%. London is an outlier to the downside, or moving lower, I should say, but you know that's because we were closed here in London yesterday. So a little bit of catch up on those losses made by other European markets yesterday. That's why London is under par, if you like, down by 0.3%. One sector that's doing pretty well is the energy sector, and not because of higher oil prices. Chrissy was just talking us through there the latest on WTI, and we see that actually moving a little bit lower today. But these are the energy stocks, and energy stocks up by 2.6%. BP is one of those, up by just over 3%. The numbers beat estimates. This for the quarterly earnings picture coming out, and by some margin. It seems that the trading environment, the volatility created by recent geopolitical developments, of course, creating opportunities to make money for trading around oil and energy products, and that is a part of the business that has delivered for BP. They're able to reward shareholders with a buyback that also goes down well with investors, of course, and offsets some of the concern around the charge they had to take, more than $25 billion related to their stake in Rosneft over in Russia. Covestro, this is a chemicals business. They've downgraded their guidance, not because of war in Ukraine, though. This is to do with lockdowns in China, and that has some spooks in the chemicals space as a result of that particular downgrade, down by just over 6% as a result. And I put it in the 10-year German bond because we have been watching this flirt with the 1% level. It pushed above 1% earlier on. We saw the UK 10-year yield go above 2%. So that broad picture of yields going higher, the sell-off in bonds continuing as we approach the Fed meeting and other key central bank meetings this week. As Kaylee said, we've heard already from the RBA this week. Let's move on to Russian assets. The big focus on the ruble, of course, is still around. Can we have more detail, please? European Commission on what exactly is and is not expected from European corporates so that they stay the right line of the right side of the sanctions rules. That's the plea from European businesses we often hear. And in terms of the debt market, a real focus on what is going on with Russia's debts that they previously paid in rubles. There was a grace period that extends to tomorrow, and will we see those coupons materialize in dollars? Bloomberg now reporting that Russia's bond payments are being processed by at least one international clearinghouse. So, Kaylee, does it look as if Russia will avoid the first international default on its debt in more than a century?
Yeah, really down to the wire on that one, Anna. Now, as we continue to watch what's going on with Russia's debt payments, let's talk about what else we will be watching today. Pfizer will be reporting its earnings results at 6:45 a.m. New York time. Then we'll get earnings results from Lyft as well as Starbucks after the market close. Plus, the Eurogroup will be meeting via video conference to discuss a draft work plan on the banking union. Creedy.
Well, Kaylee, from Europe over to Washington, there's a report that the U.S. Supreme Court is poised to overturn the landmark Roe versus Wade decision protecting the constitutional right to abortion. Politico says it obtained a draft majority opinion being circulated inside the court. Joe Matthew, Bloomberg's Washington correspondent, joins us now in D.C. Joe, a potentially historic moment. What do we know?
Yeah, this is a seismic development here in Washington. As you could just see, about 1,000 people gathered, Creedy, immediately in front of the Supreme Court when this headline broke. It will have a seismic effect nationally as well, as people likely wake up to this news. It came out pretty late last night, but indeed, a draft opinion here. It is not a ruling. Justices can still change their votes. We do expect a ruling by July. Could come in weeks, likely a couple of months. And if Republican-appointed justices stand by their positions here, it would effectively ban abortion in half the country, 26 states. Essentially what Justice Alito is writing here is that Roe was flawed in its concept because states, he says, hold the authority to regulate or prohibit abortion. He writes, we now, quote, return that authority to the people and their elected representatives, unquote. Creedy?
All right, Joe, well, as you said, the court has not yet ruled. If it does so, can that actually be a galvanizing force for the Democrats in the midterms? What are the implications?
Oh, absolutely. This is a game changer on the electoral map. If you look at some of the comments that we heard from Democrats and Republicans last evening, you can see where the lines are drawn here. And it's really something to think that we've got a war going on in Ukraine right now. We have historic inflation, so many different cross currents and issues that are driving the conversation here, but it is looking more and more likely that these elections could be decided based on the culture wars. If you consider the DeSantis versus Disney story that's happening in Florida, the conversations about abortion rights that are taking place around the country, trans rights, gender identity, these are suddenly now the stories and the issues that are driving the debate, as opposed to policy here in Washington that brings us back to inflation, the number one issue, jobs, recovering from COVID, and the war in Ukraine.
Joe, thank you very much. Bloomberg's Joe Matthew with those important developments in Washington. You can listen to Joe every weekday on his radio program, Sound On. That's at 5 p.m. Eastern Time on Bloomberg Radio. Now, the European Union is looking to Africa to help replace imports of some Russian natural gas. A draft EU document seen by Bloomberg News says countries including Nigeria, Senegal and Angola offer largely untapped potential for liquefied natural gas. Maria Tadeo, Bloomberg European correspondent, joins us now from Brussels. And Maria, as the conversations go on about when and if we'll see an oil embargo on Russian oil, the gas conversation focuses on Africa.
Yeah, Anna, and we know that the European Union has said it wants to cut down its reliance, on Russia by 2/3 this year. So that means they need to find new providers, and they believe that some of the Western African countries could actually fill that void. A lot of this, of course, will depend on the infrastructure, will depend on future contracts, and we know that gas, unlike oil, is difficult when it comes to the transportation. It needs a lot of infrastructure that comes with it, particularly with the pipelines. But it does show that the European Union is taking this seriously when it comes to unplugging from Russia. And Anna, I would point to a figure that came out on Sunday from the German government. They say that their reliance on Russian gas has gone down from 55% before the war to now 35%. The other big issue now moving to oil is this new package of sanctions, which could come in the next few days. A proposal to go for a light embargo, this gradual phase out from now until the end of the year. The Germans, by the way, they say they're now on board with this. And of course, a lot of this in anticipation to that mid-May deadline that would see potentially a big spat between the Europeans and the Russians over whether or not this gas is going to be paid in rubles or not, which European authorities say they should not pay in rubles, any European company, as that would be in breach of sanctions.
Maria, thanks very much for the update. Bloomberg's Maria Tadeo keeping across the energy news flow surrounding Brussels. Now, Citadel founder Ken Griffin says the Fed will be able to ease off monetary tightening if inflation drops to 4% by year end. He spoke at the Milken Global Conference yesterday.
If the inflation is transitory, if we are heading towards a 4% rate by the end of the year, he has a lot more room to maneuver rates in 2023. If inflation doesn't break soon here, he's going to have to hit the brakes pretty hard. That will put us into a recession.
Joining us now, Bloomberg Markets editor Christine Aquino. And Christine, really interesting that the focus there on inflation, how quickly it will come down, how long it will stay down, and how low it will get to, I suppose. Crucial for Ken Griffin's view of the world. We approach a Fed meeting where we might get some insights.
Absolutely, Anna. And I think what's going to be important for this meeting is not just confirmation of that 50 basis point rate hike that Jay Powell and his colleagues have repeatedly alluded to, but also the forward guidance on what the path is going to look like moving forward. We know that markets are still pricing for multiple 50 basis point rate hikes over the next couple of months beyond May. And so it'll be really valuable to get that insight from Jay Powell to see whether the Fed is planning to continue on that path, whether they're going to validate market pricing for it, or if they're actually going to signal some signs of potential easing off, as Ken Griffin says, if there's potential for inflation to back down by the end of the year.
Bloomberg's Christina Kina, thank you as always. We, of course, will all have our eyes on tomorrow's FOMC meeting. Let's stick with the markets, though, and go to Citigroup, saying its London trading desk was behind Monday's flash crash in Europe. Shares across the continent tumbled after a sudden 8% decline in Swedish stocks. Let's get more with Bloomberg's Tom Metcalf. Tom, walk us through what we know from Citigroup.
Yeah, so it looks like a classic fat finger crash. It appears they effectively input the transaction data incorrectly. So, a simple, almost clerical error, but it's had very huge ramifications for a very short period of time. I think the Swedish stock market dropped by something like 8%. So what we're looking at now, that was fixed. The market's kind of recovered. But what does this mean for Citigroup? Are they on the hook for any of those losses? Might they be facing lawsuits at some point in the future? Or are they kind of able to just sort of box this off and say, oh, our bad, let's all move on?
Yeah, well, a big bad at that for sure. Tom, you said fat finger, and I just instinctively took my hands off my keyboard. Thank you so much to Bloomberg's Tom Metcalf. Now let's get back to the U.S. markets and take a look at some stocks that are moving in pre-market trading. There's one in particular I want to mention in the news this morning, and that would be Stellantis. Reportedly, the company is buying the car sharing joint venture from BMW and Mercedes, so that may give it some new revenue streams. That stock is up about 1%. Another stock that is moving higher, this one on the back of earnings, is SolarEdge. Of course, a solar company really benefiting from higher demand. It saw revenue up 62% in the first quarter, and its second quarter outlook beat expectations, so that stock up about 3.4%. One stock moving lower on the back of earnings, though, is Mosaic. Of course, this one's interesting because it's a fertilizer company. We know fertilizer prices have gone up in a big way, yet it missed on both the top and bottom line. That stock is down about 2.25% before the bell, Liana.
You started there talking about car sharing, Kaylee. I used to do that for a long time. Other people, though, it seems, are pretty untidy. One of the difficulties with that model. Coming up on this program, we will talk about fixed income markets. Really fascinating day for that conversation. Ian Steely, International Chief Investment Officer for Fixed Income at JP Morgan Asset Management, joins us as we talk about the 10-year going over 3%. It did that a few hours ago. We will talk about how sustainable that kind of move is. Bloomberg is live from the Milken Conference in Los Angeles. We'll have interviews throughout the day, including Sheila Patel of B Capital and Christopher Ailman of Calstras. Lots to talk about then at that Milken Conference. Plus, don't miss Bloomberg Crypto. It is Tuesday. It's the day for it. Today at 1 p.m. New York time, 6 p.m. in London. Today, the team will be hearing from Adam Back, CEO of Blockstream, and also investor Harry Yee of the Quantum FinTech Group. This is Bloomberg.
About what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now. We are dying slowly but surely, and our lifespan is reducing every day.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Wednesday, a Bloomberg exclusive. JP Morgan Chase Chairman and CEO Jamie Dimon speaks with Bloomberg's Francine Lacqua, live from the JP Morgan CEO Summit in London, only on Bloomberg TV and Radio.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Kaylee Lines in New York and Anna Edwards in London. Matt Miller is off today. One of the big questions, the ultimate battle between the bulls and the bears when it comes to the stock market. We've seen this pretty huge sell-off year to date, but the question is, what is the case? The bull case here being you've sold off so much, valuations now back down to pre-pandemic levels. Therefore, you should naturally see a bounce back. The bears saying, well, yeah, it's back down to pre-pandemic levels, really going back to what you're seeing early of 2020, January 2020, early or late 2019. But even then, we were having the same conversations, extreme valuations, a prolonged rally thanks to the Federal Reserve support, even this idea of some of the growth slowdowns, the growth worries that we're dealing with now. Well, that was an issue about 2 years ago as well. How much of it comes down to what the FOMC is going to say tomorrow? Ksenia Galushka, Bloomberg Equities editor, joins us now. Ksenia, thank you as always for joining us. Let's get right down to it. How much of this decision, whether or not the bulls or the bears win, is based on what we hear from Chairman Powell tomorrow?
Yeah, tomorrow's meeting is going to be key. Obviously, the market has already priced in a rate hike, but what will be key is the expectations for further rate increases, because the market has been obviously very scared. We've seen stocks collapse in April. For the S&P 500, it was the worst month since 2020 pandemic starts. So the market has, for the most part, it seems, priced in the fears of a much more aggressive tightening in the Fed's policy. But let's see what happens tomorrow, because there might be further losses, or on the contrary, we might see buying in the dip as the valuations are getting more attractive with every day.
Yeah, interesting, Ksenia. I read some research recently, Bloomberg summarizing some research. I mean, you've got JP Morgan on one side saying maybe there's some upside room here. Morgan Stanley on the other side saying, no, we need to be selling the S&P from here. But then there was some interesting research suggesting that the buy the dip mentality has gone. So if you're looking for the upside, you wonder where that comes from.
It is a very interesting debate, and it does come down to the outlook on the U.S. economy. So the bulls say that, no, we're nowhere near a recession, and the growth can continue, although at a more tepid pace. And then bears are saying, no, all the signs are flashing that the recession is approaching, and earnings growth is not that strong. So it'll be very interesting to see who actually wins. Now, the earnings season has been actually surprisingly robust, and the main reason for that is that analysts were brave enough and fast enough to cut the expectations early in the year, and that's why earnings have been coming in strongly. So that's one of the reasons why stocks might have more upside going forward. Another thing is positioning. There's been massive outflows out of US and European equity funds in the past few weeks, and usually that is a contrarian sign that there might be upside from here, just because the positioning is so bearish.
Yeah, April has been uncharacteristically tough, hasn't it, for some of these markets? Ksenia, thank you very much. Ksenia Galushko with us to talk stocks. And for more market analysis, check out MLIV Go on your terminal. That is the Markets Live blog. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions. However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Kriti Gupta in New York and Anna Edwards in London. Matt Miller is off today. Now, keeping you up to date with news from around the world, here's the first word. President Biden's top trade negotiator signaled that relief from U.S. tariffs on China could be one way to confront inflation. U.S. Trade Representative Katherine Tai said the tariffs should be examined as part of a look at broader economic policy. As soon as this weekend, Tai's office may begin a review of the first group of tariffs on more than $300 billion in Chinese imports. Amazon workers at a facility in New York voted not to join an upstart union. That happened only weeks after the union won a resounding victory at a warehouse across the street. The election at a sorting center in Staten Island was not close. The Amazon labor union lost 618 to 380. Bloomberg has learned that German prosecutors have raided the offices of Morgan Stanley in Frankfurt. It's part of the investigation into the controversial CumEx trades. CumEx was a trading strategy that siphoned off at least $10.5 billion in government revenue by taking advantage of German tax laws. And the Bank of England is expected this week to raise interest rates to their highest level in 13 years. It may also clarify how it plans to sell off some of its $1.1 trillion in government bond holdings. That would take the UK's central bank into uncharted territory. None of its major economy peers have yet sold government bonds accumulated under quantitative easing since 2008. And Anna, my question for the BOE as well as the Fed tomorrow is how much room is there for a hawkish surprise, considering that Australia was able to deliver one overnight?
Yeah, it's an interesting one, although the Bank of England, of course, ahead of some other central banks in terms of the amount of interest rate hiking we've already seen, and the conversation turning into whether we are witnessing a central bank hiking into weakness. That's certainly part of the conversation here in the UK. We will maybe talk about that, but certainly about the Fed and what we're seeing in Treasury markets right now with Ian Steely, International Chief Investment Officer for Fixed Income at JP Morgan Asset Management. He joins us shortly. This is Bloomberg.
it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. A report says the U.S. Supreme Court is set to overturn the landmark Roe versus Wade decision, which has protected the constitutional right to an abortion in America. That could reshape the battle for control of Congress this fall. In markets, bonds plummet as investors brace for the biggest U.S. rate hike in more than 2 decades. The Federal Reserve begins its 2-day meeting today. Billionaire Ken Griffin tells Bloomberg the Fed needs to keep inflation at 4% this year to avoid a recession. And Citigroup says its London trading desk was behind Monday's flash crash in Europe. Shares across the continent tumbled after a sudden 8% decline in Swedish stocks. Citi says one of its traders made an error when inputting a transaction. I'm Anna Edwards in London with Kaylee Lyons and Chrissy Gupta in New York. Matt Miller is off today. And Chrissy, a lot of the focus, of course, this week on central banks. The Fed looms very large.
Yeah, the coin toss essentially between the bulls and the bears is all going to be on the FOMC meeting. And of course that we are expecting that tomorrow. And a lot of it is simply going to be what you're going to see in markets today. Remember, traditionally, the day before the FOMC meeting decision, you do start to see a risk-off tone already. In just 30 minutes, we're already seeing that. A marginal gain to start off our show. Now you're seeing a little bit of a negative tilt, and you can really see that cross-asset. No movement on the 10-year yield, really a wait-and-see kind of approach in the bond market. A similar story in the crude market, down 0.8%. Those growth concerns in China still kind of pressuring the crude market, making that spiral continue, and even Bitcoin losing a little bit of that momentum it had earlier, now up only 0.5%, Kaylee.
All right, Crudy, well, there's not all that much action in pre-market trading as well, but something I did notice is you're getting a lift really across a lot of the travel complex, including the cruise lines. Carnival out last night after the bell saying that it is the first U.S. cruise operator to restart its entire fleet after, of course, the shutdowns of the pandemic. Carnival is up about 1.4%. You're seeing a bit of a read-through into Norwegian Cruise Lines as well. It's up about 0.9. Also a little bit of a lift for some of the airlines, Anna. United is up about 0.6%. American only by about 0.25% or so. You got a lot of travel-related earnings out after the bell yesterday, the likes of Avis, which beat Expedia as well. They're not trading yet, though, in early hours, Anna.
Yeah, certainly plenty of demand for travel here in Europe. That's a real big focus for that sector. Let us have a look at where we are in Europe then. And the European equity market picture looks fairly positive, up around 0.5%. That hides some divergence. Some of the southern markets doing really quite well today. The London market underperforms, but obviously that's a catch-up story because London was closed yesterday. One of the sectors doing really well is the energy space, but that's not to do with higher energy prices. As Kriti was pointing out, actually we've seen those coming down just a little bit in the most recent session. But BP is one one of the reasons behind this. The trading business at this big giant within the energy space doing really well and helping the business to really outperform or perform very well versus expectations. And that is something that the shares have paid attention to. Also, a return of cash to shareholders, offsetting some of the concerns around the write-down that they had to take in relation to their Rosneft stake. Covestro, this is a more worrying sign. If you're looking at what's going on in China and you're thinking about how that spills through into global businesses, Covestro is a German chemicals business, downgrading their guidance today, but not because of war in Ukraine. This is to do with lockdowns and other measures that are slowing the Chinese economy. The 10-year German Bund yield, I put that in because, as Kriti showed you, the 10-year US yield, that's been flirting with 3%. We've been flirting with 1% on the 10-year German bonds. We remember when we were talking about negative rates a lot here in Europe. Well, not anymore, it would seem. Talking about 1% here, 2% here in the UK. Let's move on and show you Russian assets. A lot of questions still around the ruble payment scheme that the Kremlin wants to introduce for Russian energy assets. That's rumbling on. We're also seeing a lot of news flow surrounding the payments that Russia made on its sovereign debt, the international dollar payments, and it seems that they've been waiting until the end of this grace period. The grace period comes to an end tomorrow. We've all been waiting to find out whether that money would find its way to its end destination, and we have been reporting here at Bloomberg that at least one international clearing bank has received, or clearing house has received, that payment. So will they avert that non-payment there, that default, Kaylee?
Yeah, will those dollars end up where they need to be? That really is still the question. So we'll continue to follow that this week, but of course we're also following a slew of central bank decisions. And Santander Executive Chair Anna Botín weighed in on the path ahead for global central banks. Just take a listen.
There will be an increase in rates, and central banks, have a narrow path to go down without harming the economy, but also neutralizing inflation, which is having a negative effect on consumers. But net rates will go up.
It's a tough line to walk. Joining us now is Ian Steely, JP Morgan Asset Management International CIO for Fixed Income. Ian, let's focus on the Fed first, which of course will be out tomorrow, likely with a 50 basis point hike. In the market anticipation of that, we have a 10-year Treasury yield dancing around 3%, a 2-year at 277 or so. Is there value in Treasuries at these levels?
I think it's quite difficult to say there's actual value, given that we are at the very beginning of the rate hiking cycle. And if you look back to where we were in 2018, when inflation was nowhere near the level it is at the moment, we got up to 3.25%. So I don't see why we wouldn't be able to go through that through the second half of this year. So for us at the moment, it's a case of still remaining short treasuries and looking at other parts of the fixed income market to try to generate returns.
Ian, what are you going to be looking for specifically from the Fed this week? There's been a lot of focus on, of course, the size of the hike and how many from here we will see, how many outsized hikes we will see, what the path into the second half of the year will be. What are you looking for?
So I think what we're going to be looking for is trying to get an indication of where they see the path of rates. So we could get a surprise. There's no saying we couldn't get a surprise. We possibly could. I think there'll be at least one person voting for 75, so maybe following the RBA and maybe a little bit more hawkish on that front is a possibility. I do think they will go 50, and I think actually what I would be interested over the next few meetings is how many 50s in a row do they get? As you said, Anna, these are outsized hikes compared to what we've been used to or what we've expected through previous cycles. And then I think the bigger question is maybe what stops them doing 50? When do they say, actually, we've done enough 50s and we're now comfortable just going with 25 and going back to normal? What sort of numbers would be needing to see inflation to give that frame of mind for them? So there's a lot of hikes pricing. I think we've got 10 for the remainder of this year across 6 meetings. So at the moment, 4 50s are really expected at some point. It's going to be a case of when do we end that 50 program, I think will be more interesting from my standpoint than what they maybe do this week. So I do think we'll get 50, which is what the market's pricing.
And Ian, do you think we've seen the peak in inflation in the US? And what is the link between when we peak on inflation and when we peak on yields? Talk us through the linkages there.
So the likelihood is, whether it's now or whether it's over the next month or so, we probably have seen the actual peak in inflation. The question then will be is how quickly does it come down? How quickly do we get back to a sense of normality, or at least a sense of what the Federal Reserve is comfortable with? Are they comfortable with 3%? Are they comfortable with 4%? At least maybe over the shorter term. I think it's going to be that which will be more interesting for us is, do we hang around these very elevated levels for the next few months, or do we start to trend back down again. Year-over-year effects, we should trend down, but I still feel it does feel that inflation's a little bit sticky at the moment, and will we be moving down the pace that the Fed would like to see us moving down?
Ian, can we talk about the China question for a moment? The 10-year Treasury note now yielding more than the Chinese bond equivalent. I'm curious about the consequences of that policy divergence between the U.S., between the Fed, I should say, and the PBOC.
So I think you need to look at it from a couple of different angles, because obviously if yields in the US continue to go higher, you're going to be losing capital on the back of that. So maybe that makes them less attractive, because you've got a Fed that seems to be very committed and rightly so to raising interest rates. Whereas on the flip side, you've got the Chinese authorities who are easing policy at the moment, trying to combat the lockdowns that are going on there, although the bulk of their easing is coming on the fiscal side rather than actually on the monetary side. So that would make an argument not to own treasuries and possibly looking at China as an alternative. But I guess the flip side, that if you are an overseas investor at the moment, you do get more yield, as you rightly said, on the treasury. It's also very expensive to hedge Chinese rates. So if you actually want to buy the Chinese yield and then hedge it back to your base currencies, you basically give up most of that yield. So there's very limited carry there. So we've seen a huge amount of flow coming out of Chinese government bonds, basically reversing everything that's gone in, or a lot of what's gone in over the last few years since they've been included in indices and since they've had that attractive yield. So I think it's a more active debate at the moment. It does feel like people are actually wanting to own neither at the minute. You don't really want to own Chinese government bonds, but also you don't really want to own treasuries either.
All right, Ian, that's all on the government side. On the corporate side, how much risk are you willing to take in credit, whether quality or duration?
So I would try to remove the duration aspect of credit at the moment, given our view of higher yields. I do think we're getting to levels which are quite interesting, particularly in places like the high yield market, where you've got a spread of north of 4% on the US market, you've got a spread of north of 4.5% on the European market. And if we are right and the economies continue to grow and we expect default rates to remain very low, much lower than trend over the next 12 months or so, we do still see opportunity there. Now, again, there is a bit of a risk-off sentiment. We're seeing stocks underperforming. We're seeing credit spreads widening. But at some point, these spreads become attractive and you do need to look to step in. It has been a bit of a one-way trade this year, people not wanting to own the credit market. I do feel we're getting to levels that are looking, again, a little bit more interesting. Not quite back to where we were in mid-March, where we did see a nice relief rally. But as we approach those levels, I wouldn't be surprised to see some people stepping in.
Ian, thanks so much. Ian Seeley, JP Morgan Asset Management International CIO for Fixed Income. We were just talking with Ian about China and expectations for China. Well, Fitch cutting their Chinese growth estimates for 2022. That forecast being trimmed amid the COVID-19 outbreak, of course, and the measures being taken there, raising 2023 growth, but only by 0.1%. So the focus on that downgrade to 2022 growth. When we come back, we will talk more about that. We are going to be talking to Damian Sassower, who'll be with us to discuss. This is Bloomberg.
what's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
It is very hard to move away from China. And we're seeing that. Chinese imports to the US have been rising, not falling, despite everything. Why is this? Scale, efficiency, and they're very, very good at a lot of what they've done. I think what the new normal in supply chains is going to look like, it's a 5 to 10 year journey. It's not a 1 year one.
Citigroup CEO Jane Fraser speaking exclusively with Bloomberg yesterday. Let's stick with the China theme. Beijing going to extreme lengths to avoid the coronavirus woes suffered by Shanghai. China's capital has ordered repeat testing of most residents, halted dining in and at restaurants, and barred access to public places without a negative result. And moments ago, Fitch cut China's 2022 growth forecast to 4.3% from 4.8% earlier, but raised the forecast in 2023. To break it all down, Damian Sassower of Bloomberg Intelligence joins us now for more. Damian, this has been an issue for a while now. I'm curious about the effects of not the ripple effects that we've been talking about, the exports, but the effects of China specifically. Can it dig itself out?
I don't think so. No, I'm kidding. Look, the fact of the matter is we got the PMI data yesterday. Demand is weak. I mean, it is very weak. Consumer spending has fallen off a cliff, and it's really infrastructure spending. You have to remember, China would rather stimulate via the fiscal side of the balance sheet, not the monetary side, because as we saw in March, foreign outflows out of China government bonds, most in history, basically, because because of the rising rate differentials, which we talk about relative to the U.S. But for me, if you just look underneath the surface of the PMI data, export demand, new orders, construction activity at the worst since the pandemic. So, what that tells me is that even though China would like to stimulate through the infrastructure side, the lockdowns aren't allowing it to do that. And so, you listen to people like Leland Miller talking about maybe a fall in GDP to something on the order of 2% this year. I mean, we're not calling for something like that, but certainly the 5.5% full year 2022 GDP growth target is going to be a hard swath to manage.
Yeah, well, let's go back to the interest rate differentials. We were just talking about this with Ian Steely. This is a key point because they're trying to stimulate, but how much can they really do that? How effective is that in the face of a hawkish Federal Reserve?
Well, it's interesting. There are certain assets that are priced off spread and certain assets that are priced off yield. And as we've just realized this month, the carry trade fell off a cliff. I mean, Brazil, Chile, all these high-yielding emerging markets, basically, who have large yield differentials relative to the U.S., their currencies got clobbered. Why? Because that reach for yield isn't as important in this environment. It's going to become more of as we transition from inflation fears to growth fears, it becomes a spread game, at least in fixed income, right? It becomes about valuations. It becomes about fundamentals. No one's going to shoot for the moon in high yield. They're going to basically take what the market gives them. And that kind of creates a little bit of it kind of makes these yield differentials not as important in the mind of creditors, but it's certainly something you have to remain mindful of. But if you do shift to the fundamentals, China's not looking very good right now.
Yeah, and I'm looking at a Chinese yuan at its weakest since November of 2020. You would have to think Beijing's going to get uncomfortable with that at some point. I want to pivot, though, to Russia because, of course, the clock is ticking. There is a deadline tomorrow. The grace period will expire for that $650 million worth of coupon and principal payments. We understand, based off of breaking news this morning, that at least one clearinghouse has received and processed those payments. Where do we stand with this? Do you think it is likely that Russia is going to be able to avoid default here since it's tapped its dollar reserves?
Well, let's set it straight this Watergate. I mean, if we're talking about what's going on in Russia, it's the correspondent bank, Bank of New York Mellon, which has actually passed the money through to Citigroup, which is the paying agent. Now, Citigroup needs to get approval from the UK and the US regulators, OFAC, in order to pass those payments on to creditors. That may take time because what Citi has to do is verify that those funds came from a non-sanctioned, non-blocked account, right? Mm-hmm. So for me, yeah, even if there is a delay on tomorrow's grace period deadline, I still think they'll have a little bit of wiggle room to get that money to creditors. So you're right. It looks like Russia's going to avoid a default, an external default, their first since 1918. But what's the willingness of Putin, of Russia, to continue down this path, to continue paying? I'm suspect on that. So I'm not saying that a default is inevitable, but I mean, certainly highly likely. What's interesting about those 2022 bonds that they did make the payment on, 25 cents on the dollar prior to it, now trading at 90 cents on the dollar. If you look at Russia 5-year CDS, it was pricing in like a 99.9% probability of default. That's fallen to like 95%. On a 1-year basis, though, the probability of default has fallen from like 98% to 50%. So Russia may manage to avoid default this year, but the verdict is still out, and certainly creditors are waiting to receive their funds.
Okay, that's really interesting. So there's the short term, and then there's the long term, could be different. Damien, that's the specifics around Russia. Back to the broader emerging market story, and what is at stake this week as we hear from the Fed. We talked to Ian Seeley a little bit earlier on, and he was saying his focus is going to be just how long they're going to be keeping hiking at these sort of elevated 50 basis point levels, and what might stop them doing that. I suppose the same thing's on your mind as we look to the Fed from an emerging market perspective.
Absolutely. I mean, and I've been looking for that sort of dovish tilt from the emerging market central banks, and we have Brazil and Chile this week, right? So we're going to get a real sense. I mean, they have been some of the most aggressive central banks in terms of hiking rates in the emerging market complex to date, and we're going to see whether or not they continue to deliver rate hikes on the order of 100 basis points per meeting. The market's expecting that. We'll see if that happens, but if you look at Australia, I mean, they surprised to the upside today. Granted, they're a developed market, and they're kind of in a different place in the cycle. But, look, I do believe, again, Anna, as we transition from inflation to growth fears, it's going to be messy, and it's not going to be linear for all intents and purposes. So yeah, no, I can definitely see some aggressive central bank rate hikes choking growth across the EM complex. And growth is something that it's too short in supply for emerging markets. They're going to start to shift their focus back to that. And we'll see whether or not they can come up with the stimulus necessary to kind of maintain their economic trajectory over the near term.
Damien, thanks very much for your thoughts, as always. Damien Sassower of Bloomberg Intelligence joining us very bright and early in New York. And stay with Bloomberg for our coverage of the Fed decision and news conference. That's tomorrow, starting at 1 p.m. in New York, 6 p.m. in London. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilizers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertilizer helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the House for business's greatest minds.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Technological change is real, it's fundamental. But that doesn't mean the purchase price doesn't matter, and the entry point doesn't matter. So I think people who have benefited from this extreme low rate, high liquidity environment where growth, all manner of growth have been rewarded, I think that's where the greatest correction will come.
Mark Rowan, co-founder of Apollo Global, speaking yesterday from the Milken Institute Global Conference in Los Angeles. Now joining us is Tom Keene, co-anchor of Bloomberg Surveillance with a bow tie fit for the Met Gala. Tom, the first Monday in May is over. What chart are you looking at on this first Tuesday?
The chart I'm looking at is what Mr. Rowan's looking at. I thought that video was very, very apt to where we are right now, Kaylee. It is an adjustment world where yield is the price of money. This is in Europe and the United States. The 10-year yield in blue, the United States yield, the German yield negative, and then up. And this is a really, really instructive chart in that our yield is back to the summer of 2011. The German 10-year yield is back only to the 2014 summer. The German yield's got a long way to go to get back to what seemed normal after the great financial crisis.
Tom, you have a special lineup this morning. Ken Rogoff of Harvard, an exciting lineup.
Yeah, well, Mark Cabanas, frankly, is exciting as Professor Rogoff. Mark Cabanas is going to join us at Bank of America, really get his understanding of the new world of 3% yield. And then to have Professor Rogoff with us is a huge deal about our central banks, but really about how free-floating exchanges, foreign exchange, will adapt to what the central banks do. We could talk to them about a million things, but that's front and center today.
All right, looking forward to those conversations. Tom Keene, co-anchor of Bloomberg Surveillance, thank you so much. Now, we did just have some breaking news crossing the Bloomberg terminal. Some Russian bondholders say that they have indeed received payments in dollars. Remember, that grace period does expire tomorrow for those Russian payments, $650 million worth of coupon and principal payments. So it does look like perhaps Russia will be avoiding a default for now on that debt, as some bondholders say that they have received those payments in U.S. dollars. That is really key. Now, in addition to that, here's what else we are watching today. I will be watching Starbucks earnings after the bell. Remember, this will be the first report since Howard Schultz came back into the job as CEO. Investors are really going to want details around what his plan is after he halted Starbucks' buyback program on the day he came back. Also, China, the color around that could be really interesting here, expecting to see a big hit to same-store sales in that country as they continue to deal with COVID-related shutdowns. Grady.
Yeah, and Kaylee, Starbucks can really sometimes be a proxy for that economic growth, for spending ability for the American consumer. Some other gauges to watch, of course, and what I'll have my eye on at about 10 a.m. are those factory orders. Inventory is really key, but also those JOLTS data, job openings, and in an extremely tight labor market. What do job openings really look like? Do you start to see some of the steam really let out of that labor market, Anna?
Yeah, interesting to watch the labour market in the US, the labour market tight here in the UK as well. The focus, though, political and geopolitical, really, today. Prime Minister Boris Johnson is going to be addressing the Ukrainian parliament, we understand. He's going to be channeling Prime Minister Churchill, the wartime leader here in the UK, as he likes to do. This is Ukraine's finest hour, he will say, channeling that famous wartime speech. Zelensky, of course, channeled Churchill when he said we'll be fighting them in the forests, and similar when he addressed the UK parliament. So that is a focus. We'll also focus on the French president, though, Emmanuel Macron. He's going to be speaking to his Russian counterpart by phone. Look out for details of that conversation shortly. That is it for the early edition of Surveillance. Surveillance is ahead. This is Bloomberg.
city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
The Fed right now sets the stage for the financial markets and really also for the economy.
In terms of the economy, we are beginning to see some slowing.
It's a rare occurrence, but it does happen where both the equity and the bond markets retreat.
There is a lot of hawkishness priced in here.
Risk on, risk off doesn't exist anymore now.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. He's back, TK, alongside Lisa Abramowitz. I'm Jonathan Farrow. Futures unchanged really on the S&P after a really strong finish into the close yesterday. Tom Keene, the Fed's two-day meeting begins.
Huge close yesterday. What a moonshot up right in the last number of minutes there, John. I don't know if it sets us up for tomorrow, but I guess preordained a half a point rate increase, John, which in itself is history making, and the markets adapt and adjust. Where will we be Friday? Where will we be in the jobs report coming up?
Let's look at the battle on the south side, Tom, between Morgan Stanley and JP Morgan. Mike Wilson and his team over at Morgan Stanley.
I like that.
They want to make it clear this bear market is far from completed. JP Morgan and Marco and the team, Marko Kolanovic, saying we continue to find too much negativity in equity and credit markets.
It's a battle. I mean, it's what makes it go for us. I don't have a strong opinion either way, John. I'm looking at the correlations of the market. It's great that Ken Rogoff will be with us today with his expertise on what foreign exchange signals across the financial system.
Looking forward to that, Tom. Before we get there, Lisa, we need to talk about this bond market. A breakout in Germany, topping 1% on a 10-year yield for the first time since 2015. In the United States, a 3-year, 10-year Treasury briefly for the first time since 2018. And big moves from the RBA and Australia as well.
Even though there is an election over there, they were expected to raise rates by only 15 basis points, and they raised rates by 1/4 percentage point. What I'm looking at right now is people are starting to bottom feed in stocks because bonds are doing so badly and because people see them as potentially doing that much worse. Basically, how do we normalize at a time when inflation is at paces that we have not seen going back decades? And that really seems to be the theme here as people bring forward expectations of inflation at 3% yield on the 10-year does not seem to be the ending point for a lot of people in their belief in the market.
And they bring growth expectations down in places like China. Fitch, the latest this morning, Lisa. It was Nomura that really led the way a couple of weeks ago. Fitch joining the party.
Yeah, but still with the four handle, which is sort of shocking when you think about what's going on in Hong Kong and the shutdowns that are still going on in places like Shanghai. Honestly, this is the dilemma, and you saw it in the manufacturing ISMs that came out yesterday. They came in much weaker than expected, but still the prices were incredibly high and inflation clearly persistent.
I want to be very clear here. These are the lead stories in global markets. Tom Keene waking up in America this morning. This will not be the lead story in America. There will not be a conversation about financial markets and the economy. There will be a conversation about the controversy emerging this morning from Politico in the Supreme Court.
Huge, huge event here. For our global audience, you can't scale this leak, the historic moment of a leak from the justice system, the Supreme Court of the United States. Joe Matthew will be with us in both hours here, driving this forward. Noah Feldman of Harvard University publishing John within the hour, and he makes clear unprecedented is the only word for this moment.
The leak, Lisa, is unprecedented. The timing is controversial and the substance massively controversial.
Basically, the Supreme Court is set to overturn Roe versus Wade. This is the pivotal decision that made abortion legal in the United States. Now it will be a state-by-state decision in terms of whether abortion will be legal. This moves in a different direction than the rest of the nations, but a lot of people are pointing to what it gives the Democrats ahead of the midterm elections, given the fact that you're going to end up with perhaps greater turnout for people who really want to get the shift the other way.
We'll catch up with Joe Matthew down in Washington in just a moment. Let's start with the price action. Just briefly, as Tom pointed out, a really strong finish into the close yesterday in the equity market, bouncing back from the biggest one-day drop, going all the way back to 2020. Futures this morning positive 0.1% on the S&P 500, on the Nasdaq up by 0.1% also. That move in yields through 3%. It was a brief one. Back lower now. Lisa, 297.71 on a 10-year in America.
And this does come, as you were saying before, that two-day meeting starts of the FOMC in Washington, D.C. I'm watching ahead of the decision and the release tomorrow at what was going on in the real yield space. Basically, if you take a look at inflation-adjusted yields, they have spiked higher, decidedly in positive territory. And this, to me, is telling. People are expecting a restrictive stance from the Federal Reserve. I'm also watching two-year yields, which are at the highest levels going back to 2018. People continue to bring forward a hawkishness on the Federal Reserve as you do see these inflationary pressures persist. And related to that, at 10 a.m., we get the U.S. March JOLTS job openings data expected to come in around the record highs that we have seen, more openings than there are people who are unemployed, at least based on the numbers. All of this is basically feeding into the idea that there probably is more momentum in the labor market than a 3.6% unemployment rate really does suggest. Basically, how much and how far does the Fed have to go? And this data point may give some indication or fuel to that sentiment. And today, honestly, we have to keep a focus on what's going on in Europe. This has to do with gas prices. This has to do with some sort of cohesion in the European Union. Ministers are meeting in Brussels to discuss additional responses to Russia and Putin's insistence on paying in rubles for gas and oil. This comes as BP reported earnings, and they reported doubling of the profits, even though they reported a $25 billion or some write-off for their share in Rosneft. This just shows how much oil companies have gotten above this simply because the prices have gone up as much as they have over the past 6 months.
Bramo, thank you. Let's talk about this equity market more broadly. JP Morgan and the investment bank think we're being too negative. Marko Kolanovic and the team write the following: we feel that a pro-risk stance is reinforced by the past week's hints of more infrastructure stimulus and regulatory easing in China, 1.2, and the positive news from the Q1 reporting season. Joining us now is Ron Temple, co-head of multi-asset and head of US equity at Lazard Asset Management. Ron, let's start here. Do you think it's time to start buying, and do you really believe we've reached so-called peak fear?
I think we're approaching peak anxiety or peak fear, but let's be honest, I don't think anyone can consistently call the absolute bottom or the absolute top. But when I look at the market right now, I see some very attractive opportunities and very high quality companies that have traded down 20, 30%. The critical guide for investors has to be quality and valuation. It's really interesting. If you look at the tech market, for example, if you divide the tech industry stocks into quintiles, the most expensive quintile of tech stocks are down 47% since November versus the broad group down 22%. So you really have to focus on what you get and what you're paying for it.
Ron, I want to talk about quality. I want to make sure that we understand it as a financial ratio. When you're looking at the four accounting statements, and let's go to the favored income statement, which ratio or relationship do you use to measure quality?
We look at return on invested capital, and over time, what we've found is the level and trajectory of return on invested capital really does drive performance of the stock relative to the broader market. Now, there's a couple of sectors where that doesn't work as well, like financials, where we look at ROE. But generally, we really want to understand how does a company use its capital and what does it generate for you from that capital. And I think that's been part of what's been driving the tech part of the market for quite a long time. So again, I want to be clear, I'm not anti-tech. I think you just have to be really careful within that part of the market that you're getting companies generating free cash flow now or in the very near future, because as discount rates go up, those cash flows 5, 10 years from now are worth a lot less than they were at zero interest rates.
Ron, I want to finish up where we started, this idea of peak fear. And there are two dueling fears that are a little bit in an uncomfortable relationship with each other. There's a fear of inflation, and then there's the fear of recession. Which is the bigger fear for you at a time when there is a question of how fast the Fed will raise rates?
That's about the toughest question out there, and it's one of the reasons I'm glad I'm not Chair Powell right now. But I think what the Fed really needs to deliver is a bit of shock and awe. I think they're trying to walk this tightrope. They recognize there's a recession risk and an inflation risk. But I do believe when we look at the labor market, that's the key driver of inflation. We are either at full employment or 1 to 2 months away from it. If I were giving advice to the Fed, I would say go for 75 basis points tomorrow, send a strong signal to the market, and then watch and see what happens. And I think the biggest challenge for the Fed, by the way, is they're not only raising interest rates, they're going to start shrinking an enormous balance sheet. If we look at what these big central banks around the world have done in the last 2 years, they've grown their balance sheets by $625 million every hour of every day for 2 years.
Ron,
of course, huge amount of financial asset purchases.
Ron, as I sat at home yesterday, I had to take the day off, folks. The Red Sox are doing so poorly. They didn't play yesterday, so I had a day to recuperate. And Ron, I was sitting in my head going, I got to log extrapolate 10-year yield just to see where we're going with institutional money. A log extrapolation done very carefully of the 10-year yield gives me a 4% yield next year, literally a year from now. Do you envision a 4% 10-year if these trends continue?
I think a 4% 10-year is unlikely. I think we actually might be nearing a top in the 10-year yield. Could we get to 3.25, 3.5? Yes. But if the Fed does what it needs to do in terms of taming inflation and sending a clear message to the market, I think that will go a long way towards solving some of this fear around inflation and bringing it down. And again, the key things I'm watching are wages, and the other key factor I'm watching is rent. Because if you think about it, when you sign a 1 to 2 year lease, if your landlord raises the rent 15%, you're going to the boss pretty quickly to ask for a raise. And so we need to make sure we don't get a wage price spiral in the economy, which is, again, why I say the Fed should deliver some shock and awe.
Great to catch up with you, Ron. As always, Ron Temple of Lazard Asset Management. That seems to be the consensus view, Lisa. Not that they have to do that, that we will get this front loading from the Federal Reserve. It's the what next, what after that I think a lot of people are still considering.
What I found fascinating about what Ron was saying was basically that if the Fed needs to do what they do, we will not see that 4% or plus kind of 10-year yield. You won't see rates rise to levels that could torpedo the economy. Well, then the argument becomes, what does the Fed actually need to do?
How quickly do we get back to 4%, TK, was the question that Ken Griffin of Citadel was asking over in California over the last 24 hours at a Milken conference. 2 CPI prints coming up, Tom, May 11th, June 10th. It's going to get really important after that.
And that's on level. There's two things going on here. They're the Y and the X-axis, John, and I've spent a lot of time talking about the X-axis, this duration, which clearly we're extending out. But what about the level and the crew like Bill Dudley and Ken Griffith that say, we need to frame a higher yield? Not many people are there with them.
We'll catch up with one of the best, Tom. Looking forward to speaking to Mark Cabana of Bank of America in the next hour. Do not miss that. Futures unchanged on the S&P. Yields unchanged too. 297, 71 on a 10-year. From New York City, on radio, on TV, this is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Rishika Gupta. There's a report that the U.S. Supreme Court is poised to overturn the landmark Roe versus Wade decision protecting the constitutional right to abortion. And that prompted demonstrators to head to the court Monday night. Politico says it obtained a draft majority opinion being circulated inside the court. The opinion was said to have been written by Justice Samuel Alito. The court is scheduled to rule in the case by July. British Prime Minister Boris Johnson will evoke his own country's wartime history today when he delivers a virtual address to Ukraine's parliament today. Johnson will echo the words of Winston Churchill saying, quote, "This is Ukraine's finest hour." Meanwhile, Johnson's government has announced a new military aid package for the Ukrainians. Citadel founder Ken Griffin said the Federal Reserve will be able to ease off monetary tightening if inflation drops to 4% by year's end. But Griffin told Bloomberg that if inflation stays near the current 8.5% handle, the Fed would have to, quote, hit the brakes pretty hard, tipping the economy into recession. The Fed is expected to raise rates this week. And Beijing is going to extreme lengths to avoid the coronavirus woes suffered by Beijing. China's capital has ordered a repeat testing of most residents, halted dining in at restaurants, and barred access to public places without a negative result. Authorities are trying to avoid the lockdowns that have led to chaos over in Shanghai. And BP saw its cash flow surge and boosted its share buybacks by $2.5 billion. That may offset some of the discomfort caused by a $25.5 billion charge linked to its planned exit from Russia. BP's revenue and profit easily beat expectations. The British energy company said its oil and gas trading business had an exceptional 3 months. Global News 24 hours a day on air and on Bloomberg Quick Take. I'm Rishka Gupta. This is Bloomberg.
Has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Crypto
You have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Tuesday, a Bloomberg exclusive. JP Morgan Chase Chairman and CEO Jamie Dimon speaks with Bloomberg's Francine Lacqua, live from the JP Morgan CEO Summit in London, only on Bloomberg TV and radio.
If the inflation is transitory, if we are heading towards a 4% rate by the end of the year, he has a lot more room to maneuver rates in 2023. If inflation doesn't break soon here, he's going to have to hit the brakes pretty hard. That will put us into a recession.
That sums up the fear. That was Ken Griffin, the Citadel CEO, speaking at the Milken Institute Global Conference. Does the Fed have to make a decision in the next 12 months between supporting growth and capping inflation? That's a decision most people in this market do not want them to have to make. Futures on the S&P 500 unchanged. The Nasdaq 100 unchanged as well. Yields unchanged, 298.10. Everything unchanged, similarly, Tom. Crude, negative 0.7 to 1% at 104.41. And euro dollar has had a little look at 104 over the last few days, just about hanging on to 105 right now, 105.22 on that currency pair.
Churning markets here. The VIX 32.10. I think, John, the VIX still shows a tension out there, even with that recovery in equities yesterday.
Have we broken out into a new regime of high volatility, Tom?
Yeah, well, I'm
Amy
not
Wu
there.
Silverman of RBC is there.
I can't do a thing with my bow tie today, John.
What are you trying to do with it?
I mean, I just want to get it like on an even keel, like America is.
Biden struggled with that as well.
Yeah, he did. Did you see the president?
Yeah, he started to realize that it
did
was
someone
completely...
say something? Can he put it back in position? We haven't spoken, Tom. Did you get home okay?
I got home okay.
And last time I saw you were in the bar, and I said to the barman, make sure he gets Sakara back to his hotel okay, and I never heard from you again.
Well, what stays in Washington...
Just checking in.
Stays in Washington. Joe Matthew knows this. Joe Matthew with us now at the dinner this Saturday. He was 14 tables away from me, right front and center with the president. An equally divided Washington, fractured this morning by this story from Politico. To be clear, the media, well, they're poised or they indicate, and there's something about a draft. The language right now would, maybe the Supreme Court would, the uncertainty of Washington this morning. Joe Matthew, absolutely extraordinary. I want to go to Noah Feldman, the great Harvard scholar of this Supreme Court, publishing for Bloomberg here within, I think, the last hour. And Professor Feldman makes very clear this is about an unprecedented action of the Supreme Court. I'm waiting to get Noah Feldman up right now. There it is. It hardly matters whether it was leaked by liberals trying to shock the nation's conscience, by conservatives trying to bolster the confidence of potentially wavering justices, or by some disgruntled employee looking for a thrill or money or something else. Whatever the leaker's motive, the result is very bad. Joe Matthew, how bad is it?
You know, in the wake of the Kevin McCarthy tape leaking, no one knows who was rolling on those apparent closed conversations. This is remarkable. It is unprecedented. People are waking up, Tom, and flipping through a PDF, reading the actual draft. This isn't a leak of some information. Sources tell Politico, a source close to the matter tells Bloomberg. It's just a 98-page document. Blam, there it is on the table here. We've never seen anything like that. And it's interesting. We have had leaks from the court before, including, by the way, as Politico reminds us in its reporting this morning, from Roe v. Wade itself in 1972. The Washington Post had indications of infighting and some wrangling over this type of thing in the court. But we've never seen this. And we do want to remind people, it's very important to remember, this is not a ruling.
Right.
This could change meaningfully, although, my goodness, we're talking about the third rail here of politics, and I can't imagine that justices are going to be floundering, searching for their own opinions when it comes to something like Roe v. Wade here. We have a pretty good sense of where this court lies right now. But look, you start thinking back to those confirmation hearings, and now you know why nominees try not to answer questions about matters that could come before the court, yet all of them have said that this was being pushed by lawmakers, the law of the land, that it was precedent, yet here we are this morning talking about Roe v. Wade being invalidated.
So, Joe, there are two issues here. There's the legal procedural issue that Noah Feldman was talking about, how basically this is a draft, a first draft, and typically the Supreme Court wants to act with finality when when it actually gets released. The idea that it's being parsed through and that people are undecided raises an issue of, could justices be politically motivated or swayed in one way or another? It is not a good look. And then there is the issue of the midterm elections, how it will affect them given the fact that this is the third rail. It will galvanize voters. How much does this really help Democrats going into those midterms, because it will get some of those suburban women into the voting booth?
Yep, you just had the word there. It's suburban. That's where these races, that's where control of Washington is likely to be decided, and that is where this story is truly going to resonate here. But look, it's very difficult to tell when you consider everything else in the air right now, how exactly this might land in people's minds. It does have the promise of changing the calculus. When you start talking about single-issue voters, this is one of those issues that will bring people to the polls in one way or another. Lisa, you also used the term turnout, I think, earlier this hour, and that's the point here. It's the malaise that Democrats have been feeling. A lot of them might have just decided not to show up. This is the type of thing that gets them to show up. I would expect a march on Washington this summer, the likes of which we maybe have never seen.
Joe, there's also an issue of the fact that what this ruling would do would basically overturn the federal right to get an abortion and give it to a state level. Do we have a sense of how many states would actually reverse some of the laws and ban abortions?
This is an important question. You're right about that. Presuming this was, in fact, Alito's writing here, he's essentially saying that Roe is flawed in concept because states hold the authority to regulate or prohibit abortion. The actual quote, "We now return that authority to the people and their elected representatives." Now, so far this year, we've seen 6 states make this move to actually enact abortion bans. 26 states could follow in almost a trigger if this, in fact, does happen, if this ruling does happen. But I would also point you to a number of other states, 16 of them, that already have enacted preemptive laws, if you will. This goes back to Donald Trump actually nominating conservatives, changing the balance of the court. States got involved in this. 16 of them have laws on the books to protect the right to an abortion. In Connecticut, we've seen them go even further than this. In Vermont, they've actually gone to the point of offering an amendment to the state constitution to guarantee the right to an abortion. So in the coming weeks and months, as we learn the finality of this ruling, you're going to see quite a bit of action on the state level, and that comes back around to the midterms again. Gubernatorial races, state legislative races that we may not have been talking about are suddenly going to become priorities.
Joe, we're looking towards your coverage through the rest of this week, sir. Thank you. Bloomberg's Joe Matthew in Washington. Do not miss Sound On Bloomberg Radio weekdays at 5 p.m. Eastern Time. A big show, no doubt, Tom, coming up a little bit later.
This is so different. For our international audience, John, this is very much about, and we'll talk about this in the next hour with Joe, who's really expert on this, but it is years and years of the mix of the court. And what it's about, to me, John, is not the left and not the right, but the definition of the court in the middle. That's what's open to question.
Well, right now, it is hugely controversial with Tom Keene, Lisa Bramwitz and Jonathan Ferro. Futures negative 0.1% on the S&P. Yields unchanged, 298 on a US 10-year. For our audience worldwide, heard on radio, seen on TV, this is Bloomberg Surveillance.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Strong finish into the close yesterday on the S&P 500. We pulled back just a little bit, down 1/4% on the Nasdaq, down about 1/3 going into the Federal Reserve decision tomorrow, the two-day meeting to start today. Let's look at the bond market. 3% on a 10-year yield for the first time since 2018 in America. We pulled back from that level, breach it very briefly, 297, 71 on a 10-year right now. But globally, we're breaching some important levels here. In Germany, through 1% for the first time going back to 2015. In Australia, look at these moves. 3% on a 3-year at the front end for the first time in 8 years. Yields up by, yes, almost 20 basis points. And the Aussie dollar, the Aussie, a whole lot stronger off the back of that 25 basis point hike of the RBA. The first interest rate hike going back to the back end, Tom, of 2010.
Global tip, folks, the way that John and I look at this, and we don't do this on TV that much, but Aussie yen, and John, what a surge that is of Australian strength.
It's a big change. We're thinking about central banks that haven't hiked for a long time, actually hiking interest rates. The one central bank we're not talking about enough, though, Tom, is the Bank of Japan, the other side of that trade that you just raised.
Well, yeah, it's there, 130.09 on yen right now, and I don't know where the breakout is, 131, 132. Maybe that awaits some more news here, but certainly, and with Rogoff coming up here, Ken Rogoff in the 8 o'clock hour, John, you know, we can reframe what foreign exchange says about what these central banks can do.
What they've got in common right now, the ones that are hiking, Tom, is this conversation about front-loading rate hikes, getting it all done very, very shortly in a short amount of time, quickly. At the Federal Reserve, in Australia perhaps, they go again. The ECB is the one for me. I think they've got a meeting in early June. We get some forecasts too. That one's going to be fascinating.
What's going to be interesting here, folks, is how we picture what happens after this Fed meeting on Wednesday. Of course, into the jobs report, and of course, part of the labor economy, as we heard from Ron over at Lazard there early in the hour, is a 3.5% jobs rate is a survey statistic. That is stunning of a near fully employed America. Conrad DeQuadros joins us now, Senior Economic Advisor at Breen Capital. Conrad, I want to go back to your and John's acclaimed analogy of the putting green of 10 years ago. It's a new putting green. It's a new golf course. Where's the putting green right now for next year? How many strokes away am I?
You know, Tom, the putting green was actually 20 years ago. That's the analogy that we used back in 2003, 2004, when it seemed like the Fed was trying to get, in our view, the funds rate up to, at that time, a nominal neutral rate was somewhere around 5%. We had a 1% Fed funds rate. And at the time, we had Governor Bernanke who was talking about, fine tuning the rate up to where it needed to be. And so we were saying, that's a lot of rate hiking that needs to be done. It's not fine tuning. It's not, trying to play with a putter. to get up to the green. So that was an analogy we used a really long time ago. And this time, of course, we're in a very different environment where the Fed is trying to get to neutral much more quickly. The problem that we have, though, is with their assessment of where neutral is. And this view, and it's very widely held, even held outside the Fed, that the nominal neutral rate of interest is 2.5%. That's the view of private economists too, not ours, but most private economists. The problem that we have with that is that's where people thought the nominal neutral rate of interest was pre-COVID, when we were in a completely different inflation environment. And so, even if we're looking out further over longer periods of time, we have 10-year inflation break-evens that are at 3. We have consumer inflation expectations that have gone from a little over 2 to 3. We have 5-year PCE inflation that's 2.8%, and it was 1.6%. Inflation has moved higher, so how can the nominal neutral rate be where it was before?
What's so important in this discussion is the political mandate of the Fed, which is anathema to writing the quadros. Is politics going to intrude again and keepeth us at 2.5% instead of where you think we and Bill Dudley should be?
Well, I think politics are probably on the side of getting the Fed funds rate up, because what the Fed has learned, and actually what the Fed was being told when they were doing their Fed Listens events, is that people hate inflation. And so the political side is actually pushing the Fed to try to get this right and do what they can to rein in inflation. Now, of course, the problem is does the Fed admit that there is some monetary side to this move in inflation, or do they continue to say it's all about supply chains? And our view, and it's been our view all along, is that there is obviously the supply chains and all of those problems and war and oil prices, they all affect the cost side. But the Fed has created a monetary environment with overly easy monetary policy that's allowed those costs to pass through into final prices. And I don't think there's going to be a lot of pushback from the political side to the Fed trying to get policy on a more appropriate setting given the inflation backdrop.
Conrad, I don't want to extend the golf analogy. This is not the putter, and you know that. This is Bryson pulling out the driver with a 5-degree loft and smashing it as hard as he can for as long as he can. Conrad, I want to know where on the calendar do you think this Federal Reserve actually has to reach for the putter? That's where the conversation actually gets interesting.
Well, that's getting back to that neutral rate argument, and John, I think that's a very important question that you just asked. Now, I actually think in the near term, the market is probably too aggressive in looking for 4 50 basis point rate hikes, and that's not to say that I think that the Fed doesn't have a lot of work to do to get to neutral. In fact, as I said, I think the neutral rate is probably higher, and that terminal Fed funds rate is higher than what the market has priced in. Where I differ from what market expectations are is I don't think that the Fed will be cutting rates in 2024. I think maybe a little bit less in terms of rate hikes this year than the market has priced in, but then continuing to move the funds rate higher, because I think the nominal neutral rate, if we had an underlying inflation rate that was around 2, maybe a little bit below that, all the indications from expectations, from market pricing, from underlying inflation rates, trend inflation rates suggest that that's moved up. And I think that's probably closer to 3. And so the nominal neutral Fed funds rate is probably closer to 3.5%. I don't think the Fed gets there until 2023, 2024. But I do think that it's higher than what the Fed is telling us in their SCPs and then what private economists are responding to in terms of surveys.
The great uncertainty underpinning these projections and the balance of risks here, as Ken Griffin put out there, is how much inflation does come down. And he said yesterday at the Milken conference that if inflation does not get down to 4% this year, that will be a very bad scenario for the Fed. They will have to go much faster and much harder, and that will lead to a recession. Do you agree? I mean, do you see that basically there is a threshold for how much inflation has to wane to give the Fed the leeway to even get things under control in a somewhat controlled manner?
Lisa, I think that's another very good question, and it brings in this notion of, or the focus on peak inflation, right? And when this view that, well, we've seen the peaks in inflation, I don't really think that that's important. I think what's important is what you just brought up. How much does inflation come down? The Fed has inflation falling to around 4% this year, and then getting below 3% next year. And I think that that's a very aggressive forecast in terms of the moderation in inflation. I think we're likely to see, particularly on headline inflation rates, inflation still at 5 this year. And I don't think that we get below 3% inflation next year. I don't think that even on the aggressive path that the market has priced in, because I don't see the Fed getting to neutral until perhaps 2024. I don't see how inflation comes down with the Fed funds rate on a still accommodative setting. But effectively, what the Fed is doing by saying that the neutral rate of interest is 2.5, we need to get to neutral, maybe we go a little bit above, and then inflation will come down. If they're assuming a 2% inflation rate, so they're assuming that the inflation problem has been resolved in trying to determine the interest rate that's required to resolve the inflation problem. And I don't see how we get there with accommodative policy, which I think is going to be less accommodative, but it's still going to be accommodative. And so inflation, I think, remains quite high.
Conrad, awesome, as always. Conrad de Quadros there of Breen Capital. Thank you, sir, very much. TK, for a lot of people, the next couple of meetings might be boring, just in terms of what they do, because they expect 50
I don't agree.
after 50. I think it gets more interesting once you get those two inflation prints. I've got the dates, May 11th, June 10th, and then you have that Fed meeting June 15th with the Fed forecast on a new dot plot. That's going to be fascinating.
John, we're going to be fully engaged here. To bring it up again, I forgot it. I'm so focused on what Liverpool tots. I mean, May 4th, June 15th. Come on, John. July 27th is going to be a huge deal anyway. You slice it. John, you and I can barely concentrate off Liverpool tots this weekend. Dan Ives, of course, way out front here. John, we got to go to this. And Ron Temple mentioned this earlier, John. Everybody's readjusting the scope and scale of their price targets with this pullback. The VIX out to 32.51. Dan Ives, Apple, up 27% from here, John. That's a big number.
Has he got things to say about baseball too, Tom?
Well, no, I don't, but Dan Ives does. I mean, this is how silly it is, John.
Do you want to translate
I don't even, what this is, John, to translate for the London audience is 2 weeks into the Premier League deciding Liverpool's and, you know, whoever, Man City or whatever is going to be it. Dan Ives out with a tweet this morning screaming up the Subway Series between the Mets over at Citi Field and the Yankees up in the Bronx. And John, this is extraordinary.
Is that how deep into the year baseball goes now, October into November?
Oh, it's ridiculous. It's a scandal. They start too early and they end too late. It's ridiculous. They're going to be playing, John. There's going to be snow at Yankee Stadium.
I still can't get excited
Yankees.
about it, ever. The only time I went, Tom, and thought, wow, this is impressive, was Aaron Judge. Just seeing the size of him in real life. The guy is an absolute monster. We do have a Mets fan with us. You know, Tom.
Well, let's get her briefing
by
here.
proxy.
Lisa
By proxy.
Ramo,
Okay,
Mets
hold on a
briefing.
second. You guys kind of missed the lead here. I got to be honest.
Well,
right?
so will you tell us what's the lead?
The lead is that the Mets normally are terrible, right? I could have used other expletives, but I'm just going to say are terrible usually. They've been crushing it, right? And basically they had a no-hitter, which is incredibly rare, where they basically, nobody got a hit off of their pitchers on Friday night. They're doing incredibly, and they have an incredible record. And so he's basically coming out and saying this could actually be something unusual because normally they fall apart. And so that's what this is all about.
I mean, I would caught on to that by suggesting that they're going to be there at the end of the year.
In October or November.
Precisely.
And then why is baseball in October and November and you don't like it?
It's because that's when it ends, and if you get that far, you've done pretty well.
We do soccer talk.
Bremo, we got that.
You got there with a derivative.
No,
you did derivative.
I got there, just took it a little bit further.
That was Red Sox free talk.
Are we done with baseball?
Please.
John, we're done to baseball till June.
Bramo, if you ever want to do baseball again, just say. Anytime. You seem very passionate about it, all right? Futures down a third on the S&P. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Rishka Gupta. There's a report that the U.S. Supreme Court is on the verge of overturning the Roe versus Wade ruling that legalized abortion that prompted protesters to turn out at the court Monday night. Politico says it obtained a draft majority opinion from Justice Samuel Alito. According to the publication, Alito writes, quote, Roe was egregiously wrong from the start. If the court does overturn Roe, it could reshape the battle for control of Congress this fall. The Bank of England is expected this week to raise interest rates to their highest level in 13 years. It may also clarify how it plans to sell some of its $1.1 trillion